Welcome back, traders and learners, to our audiobook journey through Technical Analysis Explained by Martin Pring. We're diving deeper into the Technical Trader's Toolkit, and trust me, this is where the charts come alive. From here on, it's all about sharpening your edge and spotting market moves before they happen. Let's break down the exciting chapters from 6 to 12. Chapter 6, Trend Lines. This is where you start seeing the market's heartbeat. Trend lines help you understand the direction and strength of price movements. Pring shows you how to draw them with precision and interpret what they really say about investor sentiment. A must-know skill for timing your trades like a pro. Chapter 7, Basic Characteristics of Volume. Volume isn't just noise, it's the voice of the market. This chapter uncovers how volume confirms price trends, signals reversals, and reveals the conviction behind every move. Learn why volume precedes price and how to use it to your advantage. Chapter 8, Classic Price Patterns. Ready to unlock the power of pattern recognition? From head and shoulders to double tops, these formations are the fingerprints of crowd psychology. This chapter equips you to read these signals and anticipate breakouts or breakdowns like a seasoned technician. Chapter 9, Smaller Price Patterns and Gaps. Sometimes, big moves start with small hints. Here, we explore flags, pennants, and the story behind price gaps. Learn how these smaller patterns can signal explosive short-term opportunities, if you know what to look for. Chapter 10, 1 and 2 bar price patterns. Speed matters in trading, and this chapter is for those who thrive on sharp, quick signals. Discover how single and double bar patterns, like inside days and key reversals, offer powerful insights into momentum shifts and entry-exit points. Chapter 11, Moving Averages. Every trader's favorite tool, and for good reason, moving averages smooth out price action and help you identify trends with clarity. Pring explains how to use them effectively, including crossovers and dynamic support resistance zones. Chapter 12, Envelopes and Bollinger Bands. Now we take it up a notch. These indicators wrap price action in a dynamic range, helping you spot overbought or oversold conditions. Bollinger Bands in particular add volatility into the mix, showing you when prices are about to break out of their shell. Whether you're a beginner or brushing up on the essentials, these chapters are packed with timeless insights and practical tools. So buckle up. Your chart reading skills are about to reach a whole new level. If you're enjoying the journey, don't forget to like, follow, and share this audiobook series. Let's keep sharpening your edge in the markets, one chapter at a time.
Chapter 6, Trend Lines. Trend lines are perhaps the simplest of the tools we use in the technical arsenal and are arguably one of the most effective. Since the construction of nearly all price patterns requires the use of trend lines, this concept is a fundamental building block of pattern identification and interpretation, the subject of Chapter 8. In this chapter, we will describe trendline characteristics and explain how the significance of individual lines can be determined. A trend line is a straight line connecting either a series of ascending bottoms in a rising market or the tops of a descending series of rally peaks. Those joining the lows are called up trend lines, and those connecting the tops are referred to as downtrend lines. It is also possible to construct horizontal trend lines joining a series of identical lows or identical highs. Typically, a downtrend line is constructed by joining the final peak with the top of the first rally, as in Figure 6.1. When the price breaks above the trend line, a trend change signal is given. The opposite is true for an uptrend line. See Figure 6.2. How to draw trend lines. In order for a line to be a true trend line, it must connect two or more peaks or troughs. Otherwise, it will be drawn in space and will have no significance. You will often see people constructing lines that only touch one point, as in Figure 6.3, or even no points at all, as in Figure 6.4. Such lines have no meaning whatsoever and are really worse than drawing nothing at all. This is because, by simply appearing on the charts, such lines give the observer the impression that they actually have some significance. It's a fundamentally important point because major technical principle. A true trend line is a graphic way of representing the underlying trend. Consequently, if it only touches one point, it cannot be true trend line. Ideally, an uptrend line is constructed by connecting the final low with the first bottom in the rally, as line AD in Figure 6.5. This is called the primary trend line. In the case of a primary trend, this would be the bear market low and the first intermediate bottom. The example shown here offers a fairly shallow angle of ascent. Unfortunately, the price rallies sharply, which means that the violation develops well after the final peak. In such situations, it is better to redraw the line as the price moves up. In Figure 6.5, this is line BC, which is obviously a better reflection of the underlying trend. This is called a secondary trend line. Downtrend lines are constructed using the same principles, but in reverse. Since trends can be sideways, it follows that trend lines can also be drawn horizontally, which is often the case when we construct price patterns such as the neckline of a horizontal head and shoulders H and S pattern, or the upper or lower boundaries rectangles, described in later chapters. In the case of price patterns, the penetration of these lines usually warns of a change in trend, as does the violation of rising or falling trend lines. It's important to understand the following principle at this point. Major technical principle: drawing trend lines is more a matter of common sense rather than following a set of hard and fast rules. Bar versus line are close-only charts. Some charts are plotted with bars and others as line charts. The question naturally arises as to which form should be used for the purposes of trendline analysis. In most cases, bar charts offer more timely signals, whether it's a peak and trough progression, price pattern completion, or trendline violation. In technical analysis, timeliness comes with a price, and the price in this case is more whipsaws. With traditional daily or weekly charts, the closing price is very important because it sorts out the men, i.e., those who are willing to take home a position overnight or over a weekend, from the boys, i.e., those who are not. This has become less important as a factor for markets that trade for 24 hours, Sunday through Friday. However, since all markets are closed over the weekend, Friday closes continue to maintain their importance. Even so, closing prices are, for the most part, more important chart points than highs or lows. Also, since there is much excitement during the day as unexpected news breaks, highs and lows often represent random points on the chart. For this reason, it is often a better idea to construct trend lines using closing data. I'm not going to say that's always the case, because some bar trend lines have greater significance than close-only ones, based on the rules outlined for significance described later in this chapter. Thus, it is always crucial to apply common sense as much as strict technical rules. The question you should be constantly asking is, which line better reflects the underlying trend? Trendline breaks can be followed by a reversal or consolidation. The completion of a price pattern can signify either 1. A reversal in the previous trend. In this instance, it is known as a reversal pattern. Or 2. A resumption of the previous trend, when it is called a consolidation or continuation pattern. Similarly, the penetration of a trend line will result in either a reversal of that trend or its continuation. Figure 6.6 illustrates this point from the aspect of a rising price trend. In this case, the trend line joining the series of troughs is eventually penetrated on the downside. The fourth peak represented the highest point in the bull trend, so the downward violation of the trendline signals that a bear move is underway. The upward price trend and trendline penetration in Figure 6.7 are identical to those in Figure 6.6, but the action following this warning signal is entirely different. This is because the trendline violation results in the advance continuing, but at a slower rate. A third alternative is that the price consolidates in a sideways trading range and then advances, Figure 6.8. Finally, it may consolidate and then reverse to the downside. This is shown in Figure 6.9. Thus, whenever a trend line is violated, the odds strongly favor a change in trend. That change can either be an actual reversal or a sideways trading range following an uptrend or downtrend. In most instances, there is, unfortunately, no way of telling at the time of the violation which possibility will prove to be the outcome. Generally speaking, though, the violation of trend lines with a sharp angle of ascent or descent is more likely to result in a consolidation. Also, valuable clues can be gleaned by applying other techniques described in subsequent chapters, and by evaluating the state of health of the market's overall technical structure examined in Part Roman II. Using the techniques discussed in Chapter 8 can also help. For example, in a rising market, a trendline penetration may occur at the time of, or just before, the successful completion of a reversal pattern. An example is shown in Figure 6.10. Figure 6.11 illustrates the same phenomenon from the aspect of a bear market reversal. If the violation occurs simultaneously with, or just after, the completion of a reversal pattern, the two breaks have the effect of reinforcing each other. Sometimes, as in Figure 6.12, the trendline violation occurs before the completion of the pattern. In such cases, the break should be regarded as a sign of an interruption of the prevailing movement rather than one of reversal, because a trend is assumed to continue until the weight of the evidence indicates otherwise. A couple of examples of this phenomenon appear in Chart 6.1, featuring Invesco Energy Fund. This chart indicates two examples of where a trendline break and pattern completion develop close together. At the end of 1990, the Invesco Energy Fund violates a nice uptrend line and shortly after completes a right-angled broadening top. The end of the decline is signaled with another downtrend line break and the completion of a reverse head and shoulders pattern. For a full description of these patterns, please refer to Chapter 8. Further clues to the significance of a specific trendline violation can be gleaned from volume characteristics, as described in the next chapter. For example, if a series of ascending peaks and troughs is accompanied by progressively lower volume, it is a sign that the advance is running out of steam, since volume is no longer going with the trend. In this instance, a trendline violation is likely to be of greater significance than if volume had continued to expand with each successive rally. It is not necessary for a downside penetration to be accompanied by high volume, but a violation that occurs as activity expands emphasizes the bearish undertone because of the obvious switch in the demand/supply balance in favor of sellers. Major technical principle. As a general rule, the violation of trend lines with a sharp angle of ascent or descent is more likely to result in a consolidation than a reversal. Extended trend lines. Most people observe the violation of a trend line, then assume that the trend has changed and forget about the line. This is a mistake because an extended line can become just as important as the pre-violated line itself. The difference is that an extended line reverses its role. Just as a return move often happens following a breakout from a price pattern, a similar move, known as a throwback, sometimes develops following a trendline penetration. Figure 6.13 shows a trendline reversing its previous role as support, while the throwback move turns it into an area of resistance. Figure 6.14 shows the same situation for a declining market. Chart 6.2 shows an uptrend line break for the China ETF FXI. The penetration of this line resulted in the extended line becoming resistance. Later it was penetrated again, and a subsequent decline showed it to be a level of support. Finally, two trend lines converged in early March, and since they had just been violated on the downside, they circumflex reinforced each other as a resistance zone that quickly resulted in the price moving to the downside. Major technical principle. An extended trend line reverses its support/resistance role. Logarithmic ratio, VS. Arithmetic scales scaling is an issue that is often overlooked in the technical community, but since it can have an important influence on how trend lines can be interpreted, this is as good a place as any to introduce this concept. There are two axes on any market chart. The x-axis, along the bottom, registers the date except in point and figure charting, and the y-axis, the price. There are two methods of plotting the y-axis, arithmetic and logarithmic. Which one is chosen can have very important acircumflex implications. Arithmetic charts allocate a specific point or dollar amount to a given vertical distance. Thus, in Chart 6.3, each arrow has the same vertical acircumflex distance and reflects approximately 250 points. That will be true at any price level. A logarithmic scale, on the other hand, allocates a given percentage price move to a specific vertical distance. In Chart 6.4, each arrow represents a move of approximately 100%, whether it is at lower prices or higher prices. There is very little noticeable difference between the scaling methods when charts are plotted over short periods of time, where price fluctuations are relatively subdued. However, with large price fluctuations, there are considerable differences. The arithmetic scale suppresses price fluctuations at low levels and exaggerates them at high points. Thus, the 85% 1929-1932 decline hardly shows up at all in Chart 6.3, but the 40% late 1990s, early 2000s retreat, no small decline, is greatly exaggerated. Chart 6.4 shows that the logarithmic scaling brings back 1929 and does not exaggerate the turn of the century bear market. The media love to hype stories and news because that is what sells. You will find that charts featuring financial markets or economic numbers are almost always plotted on an arithmetic scale because this has the effect of exaggerating the most recent changes. Another hyping technique used by the media is to present the data for a short period using a very limited scale. The reader is then left with the sense of a dramatic move. This would not be the case if the data were displayed over a much longer period using a wider price scale. As you can appreciate, I am very much in favor of using a logarithmic scale because it displays price trends in a proportionate way. Psychology tends to move proportionately as well, so it makes perfect rational sense to use logarithmic scaling. Having said that, when price fluctuations are relatively small, say, over a 3-month period, there is very little difference between the two scaling methods. As a purist, though, I still prefer the log scale at all times. There is an even more important advantage of the logarithmic scale, which we shall learn when the concept of pattern price objectives is discussed later. But for now, let's consider the implications for trendline interpretation. The choice of scale is important for a timely and accurate use of trendline analysis, because at the end of a major movement, prices tend to accelerate in the direction of the prevailing trend, i.e., they rise faster at the end of a rising trend and decline more sharply at the termination of a bear market. In a bull market, prices rise slowly after an initial burst and then advance at a steeper and steeper angle as they approach the ultimate peak, looking rather like the left-hand cross-section of a mountain. Chart 6.5 shows an uptrend line break for Intel based on a logarithmic scale. Note that the downside penetration develops in mid-December. Chart 6.6 shows exactly the same period, but this time, the scaling is arithmetic. The trendline break is entirely different since it initially comes as a whipsaw in late December, followed by a valid break in mid-January. The downward pointing arrow on the left marked the logarithmic break. Thus, it is apparent that uptrend lines are violated more quickly on a logarithmic than on an arithmetic scale. Conversely, downtrend lines are violated sooner on an arithmetic scale. This can be seen from a comparison of charts 6.7 and 6.8 for IBM. Generally speaking, penetration of a logarithmically drawn trend line is more accurate in reflecting trend reversals than is penetration of an arithmetically drawn trend line. However, if the arithmetically constructed one is substantially more significant, based on the criteria listed next, then that would be the one to go with. Significance of trend lines. It has been established that a break in trend caused by the penetration of a trend line results in either an actual trend reversal or a slowing in the pace of the trend. Although it may not always be possible to assess which of these alternatives will develop, it is still important to understand the significance of a trendline penetration. The following guidelines should help in evaluation. Length of the line. The size or length of a trend is an important factor, as with price patterns. If a series of ascending bottoms occurs over a 3 to 4 week span, the resulting trend line is only of minor importance. If the trend extends over a period of 1 to 3 years, however, its violation marks a significant juncture point. Just remember, big trends result in big signals, small trends in small signals. Number of times the trend line has been touched or approached. A trend line also derives its authority from the number of times it has been touched or approached, i.e., the larger the number, the greater the significance. This is true because a trend line represents a dynamic area of support or resistance. Each successive test of the line contributes to the importance of this support or resistance, and thus the authority of the line is a true reflection of the underlying trend. Just remember that a close encounter to the line and approach is almost as important as an actual touching, because it still reflects the line's importance as a support or resistance area. Also, if a line gains significance from the fact that it has been touched or approached, the extended line will become equally as important, but from a reverse point of view, since extended lines reverse their support/resistance functions. Angle of ascent or descent. A very sharp trend, as in figure 6.15, is difficult to maintain and is liable to be broken rather easily, even by a short sideways movement. All trends are eventually violated, but the steeper ones are likely to be ruptured more quickly. The violation of a particularly steep trend is not as significant as that of a more gradual one. Penetration of a steep line usually results in a short corrective movement, following which the trend resumes, but at a greatly reduced and more sustainable pace. Usually, the penetration of a steep trend line represents a continuation rather than a reversal break. Major technical principle. The significance of a trend line is a function of its length, the number of times it has been touched, and the angle of ascent or descent. Measuring implication. Trend lines have measuring implications when they are broken, just as price patterns do. The maximum vertical distance between the peak in the price and the trend line is measured during a rising trend. See figure 6.16. This distance is then projected down from the point at which the violation occurs. The opposite for an uptrend line violation is shown in figure 6.17. The term price objective is perhaps misleading. Objectives are usually reached when a trendline violation turns out to be a reversal, but because they are more often exceeded, as with price patterns, the objective becomes more of a minimum expectation. When prices move significantly through the objective, this area often becomes one of resistance to the next major rally or support for a subsequent reaction. Figures 6.18 and 6.19 show the sum of these possibilities in both a down and up market. Time and again, these price objective areas prove to be important support or resistance points. Unfortunately, there is no way to determine where the actual juncture point will be for any rally or reaction. This emphasizes a point made earlier, that there is no known way of consistently determining the duration of a price movement. It is only possible to speculate on the probability that a specific area will prove to be an important turning point. Corrective fan principle. At the beginning of a new primary bull market, the initial intermediate rally is often explosive, and so the rate of ascent is unsustainably steep. This happens because the advance is often a technical reaction to the previous overextended decline, as speculators who were caught short rush to cover their positions. As a result, the steep trend line constructed from the first minor reaction is quickly violated. This is represented as line AA in figure 6.20. A new trend line is then constructed, using the bottom of this first intermediate decline AB. The new line rises at a less rapid rate than the initial one. Finally, the process is repeated, resulting in construction of a third line AC. These lines are known as fan lines. There is an established principle that once the third trend line has been violated, the end of the bull market is confirmed. In some respects, these three rally points and trend lines can be compared to the three stages of a bull or bear market, as outlined in Chapter 3. The fan principle is just as valid for downtrends, and can also be used for determining intermediate as well as cyclical movements. Trend channels. So far, only the possibilities of drawing trend lines joining bottoms in rising markets and tops in declining ones have been examined. It is also acircumflex useful to draw lines that are parallel to those basic trend lines, as shown in figure 6.21. In a rising market, the parallel line known as a return trend line joins the tops of rallies, and during declines, the return line joins the series of bottoms. See figure 6.22. The area between these trend extremities is known as a trend channel. The return line is useful from 2 points of view. First, it represents an area of support or resistance, depending on the direction of the trend. Second, and perhaps more important, penetration of the return trend line represents a signal that either the trend will accelerate or a reversal in the basic trend is about to take place, at least temporarily. In Figure 6.23, the violation of the return line signifies that the price advance has begun to accelerate. In effect, the channel in Figure 6.23 represents a rising trading range, and the trendline violation is a breakout from it. Exhaustion. On the other hand, if the angle of the trend channel is much steeper, as in Figures 6.24 and 6.25, the violation of the return line represents an exhaustion move. The failure of the price to hold above or below the return line then signals an important reversal in trend. This is often the case if the break through the return line is accompanied by high volume. Consider a situation in which a person is sawing a thick piece of wood. At first, the sawing strokes are slow but deliberate, but gradually, the person realizes that this task is going to take some time, becomes frustrated, and slowly increases the speed of the strokes. Finally, the person bursts into a frantic effort and is forced to give up the task, at least temporarily, because of complete exhaustion. The same principles hold true in a declining market. In this case, the expanding volume at the low represents a selling climax. As a general rule, the steeper the channel, the more likely it is that the breakout will turn out to be an exhaustion move. Exhaustion also develops when a price rallies temporarily above a regular downtrend line or below an uptrend line and then breaks back below or above it. In the case of a downtrend line, the situation is akin to someone jumping up and temporarily pushing through the ceiling. The person is able to pull their head through to the next floor for a few moments, but then falls sharply back to the floor below. At this point, he has used up all spare energy in the attempt to move to the next floor and is totally exhausted. Before he can make another attempt, he will need some time to gain some new energy. The same is true of the price, which makes an effort to rally above the trend line but is unable to maintain the breakout. This temporary break often indicates that the prevailing trend has much further to run. It also raises a dilemma concerning the way in which a trend line should be constructed. In Figure 6.26, for instance, we see a false break above trendline AB. Should AB now be abandoned, or should the peak of the exhaustion break be connected to the rally high to form a new dashed AC trendline? Again, it's a matter of common sense. On the one hand, the top of the whipsaw break is technically the correct place to draw the line, but common sense suggests that the original line is a better reflection of the underlying trend. After all, at the time of the whipsaw, it had been touched 3 times. If a new line is then drawn to reflect the break, that line will have been touched only twice, once at the outset and once at the whipsaw peak. In a sense, the whipsaw is adding further credibility to the initial line because the price was unable to hold above it. If we had come upon this acircumflex situation after the whipsaw break and tried to construct a line, it would have been even more obvious that line AB was far superior to line AC because it has been touched or approached on far more occasions. Chart 6.9 shows that a resistance trendline joining the 1974 low and 1978 highs was temporarily violated. This proved to be an exhaustion move, since the S&P composite was unable to hold above the line. This failure was followed by the 1987 crash. Not all exhaustion moves result in such dynamic consequences, but they certainly warn of potential trouble and should never be ignored. The same principles are true in reverse for an uptrend line. When you think about it, a whipsaw break actually adds credibility to the trend line. This is because the price is able to violate the line, but this line is so significant as a support/resistance area that the price is unable to hold the break. If it were not such a significant barrier, the break would have held and the whipsaw would have been avoided. Consequently, when the price is able to experience a valid break, the signal is that much stronger. Chart 6.10 shows an example of a whipsaw downside break for Microsoft in 1998. Major technical principle: exhaustion develops when a price rallies temporarily above a downtrend line or below an uptrend line and then breaks back below or above it. Summary: 1. Trend lines are perhaps the easiest technical tool to understand, but considerable experimentation and practice are required before the art of interpreting them can be successfully mastered. 2. Trendline violations signal either a temporary interruption or a reversal in the prevailing trend. It is necessary to refer to other pieces of technical evidence to determine which is being signaled. 3. The significance of trend lines is a function of their length, the number of times they have been touched or approached, and the steepness of the angle of ascent or descent. 4. A good trend line reflects the underlying trend and represents an important support and resistance zone. 5. Extended trend lines are an important concept and should not be overlooked. 6. Exhaustion breaks often possess good predictive power. Chapter 7. Basic characteristics of volume. Almost everything that technicians use in plotting a specific security involves either the price itself or a statistical variation on it. Volume can offer a new dynamic in our interpretation of crowd psychology. Therefore, analyzing volume trends gives us a better understanding of how and why price patterns work. In effect, the study of the characteristics of volume gives greater depth to the weight of the evidence approach described earlier. Volume not only measures the enthusiasm of buyers and sellers, but also is a variable that is totally independent of price. In this chapter, we will discuss some general principles of volume interpretation, and in Chapter 26, some individual volume indicators. We are beginning our volume coverage at this point, as it is a basic building block of price patterns, in a similar way to the concepts of support and resistance, peak and trough analysis, and trend lines. At the end of this chapter, all the basic building blocks will have been covered, leaving us prepared to tackle the subject of price patterns head-on. Benefits of volume studies. Volume studies offer three major benefits. 1. When price and volume patterns are compared, it is important to see whether they are in agreement. If so, the probabilities favor an extension of the trend. 2. If price and volume disagree, this tells us that the underlying trend is not as strong as it looks on the surface. 3. Occasionally, price action offers mild signs of an impending trend reversal, but volume can throw up characteristics of its own that literally shout this message. In such cases, a study that was limited to price action would fail to uncover a really good and obvious warning or opportunity. Principles of volume interpretation. 1. The first and most important principle is that volume typically goes with the trend. It is normal for activity to expand in a rising market and to contract in a declining one. See Figure 7.1. In this sense, volume is always interpreted in relation to the recent past. Comparing 21st century 1 billion plus share days on the New York Stock Exchange, NYSE, with early 20th century levels of 5 or 6 million is of little help. Such a comparison reflects institutional, not psychological changes. Volume is higher today because of more companies being listed, the advent of derivatives, lower commissions, and so forth. On the other hand, a 3 billion share day this week compared to a recent 1.5 billion share day last month is relevant, because it shows a significant change in activity over a period in which major institutional changes will be non-existent. We know that when prices move in trends, this does not occur in a straight line. Instead, the price works its way up and down in a zigzag fashion. Volume trends are similar. On the left side of Figure 7.2, for instance, the solid arrows indicate an expanding volume trend and the dashed ones declining trends. It is apparent that the level of activity does not expand in every period. There are quiet periods and active ones, but the general thrust is up. It, too, is irregular. When we talk about volume rising or falling, we are usually referring to its trend. It is normal for such trends to be interrupted by aberrations in volume levels. Volume trends, like price trends, can be intraday, short, intermediate, or long, depending on the nature of the chart. The amount of money flowing into a security must always equal the amount of money flowing out. This is true regardless of the level of volume. Consequently, it is the degree of enthusiasm of buyers or sellers that determines the course of prices. If buyers are bullish, they will raise their bids until their demands are satisfied. If sellers react to bad news, they may panic, pushing prices down sharply. But at all times, the amount of a security being sold is equal to that being purchased. 2. The combination of rising volume and rising price is normal. It indicates that things are in gear. Such a state of affairs has no forecasting value, except to imply that it is likely that a negative divergence between price and volume lies ahead. 3. Volume normally leads price during a bull move. A new high in price that is not confirmed by volume should be regarded as a red flag, warning that the prevailing trend may be about to reverse. In Figure 7.3, the price peaks at point C, yet the average volume reached its maximum around point A. Such action is normal. The declining volume peaks warn of underlying technical weakness. Unfortunately, there are no hard and fast rules about how many divergences precede a peak. Generally speaking, though, the greater the number of negative divergences, the weaker the underlying technical picture. Also, the lower the peaks relative to each other, the less enthusiasm is being generated and the more vulnerable the technical position becomes. Once buying dries up or selling enthusiasm intensifies. A new high that is accompanied by virtually no volume is just as bearish as a new price high with virtually no upside momentum. An example is shown in Chart 7.1 for Allegiant technology, where you can see that the volume clusters gradually become smaller as the price rallies. Eventually, this negative technical characteristic is confirmed as the price violates the 2010-2011 uptrend line in early July 2011. 4. Rising prices accompanied by a trend of falling volume, Figure 7.4, is an abnormal situation. It indicates a weak and suspect rally and is a bear market characteristic. When it is recognized, it can and should be used as a piece of evidence pointing to a primary bear market environment. Volume, a circumflex, measures the relative enthusiasm of buyers and sellers. When it shrinks as prices rise, the advance occurs because of a lack of selling rather than because of sponsorship from buyers. Sooner or later, the trend will reach a point where sellers become more motivated. After that, prices will start to pick up on the downside. One clue is provided when activity increases noticeably as the price starts to decline. This is shown in Figure 7.5, where you can see that volume starts to pick up as the price starts a sell-off. In such situations, it is not necessary for volume to expand throughout the decline, as it does in this example. It could be that it picks up for 2 or 3 bars just after the peak. In fact, this would be a more typical situation. Figure 7.6 shows how the volume configurations change between a bull market and a bear market. Chart 7.2 shows the final rally being accompanied by a trend of declining volume for cores. When the lower trend line is violated, volume picks up noticeably. In this instance, we have one bearish volume configuration that is instantly followed by another. Chart 7.3 shows several bear market rallies in which the rising price trend is accompanied by declining volume for Radio Shack. 5. Sometimes both price and volume expand slowly, gradually working into an exponential rise with a final blow-off stage. Following this development, both volume and price fall off equally sharply. This represents an exhaustion move and is characteristic of a trend reversal, especially when supported by a 1 or 2 bar price pattern discussed in subsequent chapters. The significance of the reversal will depend upon the extent of the previous advance and the degree of volume expansion. Obviously, an exhaustion move that takes 4 to 5 days to develop will be nowhere near as significant as one that develops over a matter of weeks. This phenomenon is termed a parabolic blow-off and is featured in Figure 7.7. Unfortunately, exhaustion, or blow-off, moves such as this are not easy to define in the sense that it is possible to construct clearly definable trend lines or price patterns. For this reason, it is usually not possible to spot the terminal phase until a period or so after volume and price have reached their crescendos. Furthermore, because of their nature, parabolic blow-offs are quite rare. Chart 7.4 uses Newmont mining to demonstrate a classic example of an exponential increase in both price and volume that ends in tears in the form of an abrupt reversal in late September 1987. We see another in Chart 7.5 featuring AMREP Ordinary. 6. A selling climax is the opposite of a parabolic blow-off. It occurs when prices fall for a considerable time at an accelerating pace, accompanied by expanding volume. Prices typically rise after a selling climax. The low that is established at the time of the climax is unlikely to be violated for a considerable time. I emphasize the word unlikely because there are no guarantees, just a strong probability. Clearly, a selling climax is likely to be more of an indication of a final short or intermediate term bottom in a bull market. A price rise from a selling climax is by definition accompanied by declining volume. This is the only time when contracting volume and a rising price may be regarded as normal. Even so, it is important to make sure that volume expands on subsequent rallies, as indicated in Figure 7.8. The termination of a bear trend is often, but not always, accompanied by a selling climax. Unlike parabolic blow-offs, which are quite rare, selling climaxes appear on the charts far more often and are, therefore, quite a common technical phenomenon. In Chart 7.6, we see a selling climax develop in 2010 for Anadarko Petroleum. This is then followed by a rally and a subsequent test on lower volume. Note how volume declines on the rally, a perfectly normal characteristic following a selling climax. 7. When prices advance following a long decline and then react to a level at, slightly above, or marginally below the previous trough, this is a bullish sign if the volume on the second trough is significantly lower than the volume on the first. There is an old saying on Wall Street, "Never short a dull market." This saying applies very much to this type of situation, in which a previous low is being tested with very low volume. Such a situation indicates a complete lack of selling pressure. See Figure 7.9. 8. A downside breakout from a price pattern, trend line, or moving average MA that occurs on heavy volume is abnormal and is a bearish sign that confirms the reversal in trend. Figure 7.10. When prices decline, it is usually because of a lack of bids, so volume contracts. This is normal activity and does not give us much information. However, when volume expands on the downside, it is because sellers are more motivated, so the decline, other things being equal, is likely to be more severe. 9. When the price has been rising for many months, an anemic rally, Figure 7.11, accompanied by high volume indicates churning action and is a bearish factor. An example featuring Dresser Industries is shown in Chart 7.7. 10. Following a decline, heavy volume with little price change is indicative of accumulation and is normally a bullish factor. Figure 7.12. 11. Record volume coming off a major low is usually a very reliable signal that a significant bottom has been seen. This is because it indicates that an underlying change in psychology has taken place. Such reversals in sentiment are usually of a primary trend magnitude. Examples in the U.S. stock market developed in March 1978, August 1982 and 1984, and October 1998. A similar pattern also developed at the 1987 low in bonds and eurodollars. This is not an infallible indicator, though, because record volume was achieved in January 2001 for both the NYSE and NASDAQ, yet this did not turn out to be the final low for the bear market, which was achieved over a year later in October 2002. 12. When volume and price expand at a sharp pace, but short of a parabolic blow-off, and then contract slightly, this usually indicates a change in trend. Sometimes this is an actual reversal, and at other times a consolidation. This phenomenon is featured in Figure 7.13 and represents a temporary exhaustion of buying power. It is associated with several 1 and 2 bar price patterns discussed in later chapters. The example shows the price eventually selling off, but it could just as easily have risen. All the volume crescendo is telling us is that buyers are exhausted and we should expect a pause. When that buying is exceptionally heavy, a more bullish extreme in sentiment is indicated and is more likely to be followed by an extended period of price erosion, as shown in Figure 7.13. 13. When the price experiences a small rounding top and volume experiences a rounding bottom, This is a doubly abnormal situation, since price is rising and volume is falling as the peak is reached. After the peak, volume expands as the price declines, which is also abnormal and bearish. An example is shown in Figure 7.14. An example featuring Microsoft is featured in Chart 7.8. Note how the letter N characterizes the price action, whereas the volume configuration is closer to letter U. 14. When the price volatility shrinks to almost nothing and volume does the same, this indicates total disinterest. When the situation is eventually resolved, this is often followed by an above-average price move. In Figure 7.15, for instance, price and volume fall to the kind of levels where the slightest movement in either direction will signal a dramatic price movement. In this case, the downtrend line is violated on the upside and volume explodes. So too do prices. Generally speaking, the quieter the price and volume action relative to the preceding downtrend, the more explosive the confirmed subsequent rally is likely to be. In this case, confirmed means some kind of a price trend reversal accompanied by expanding volume. A very narrow balance between buyers and sellers is certainly apparent in Chart 7.9, which features Isaac Bank. Note the shrinking volatility of the price activity and the accompanying trend of lower and lower volume. The balance between buyers and sellers is extremely fine as we roll into early September. Then the price breaks to the downside and volume expands. That's the signal for an above-average price decline. None of the indicators used in the technical arsenal are guaranteed to work every time. This is certainly true of volume characteristics. However, when volume is used in combination with price characteristics in pattern interpretation, trendline violations, and moving average crossovers, it greatly enhances the probability that a specific setup or formation will work. As we discuss specific price examples in subsequent chapters, the basic volume principles described here will be expanded to suit individual cases. You will also be able to appreciate at this point that most of the time volume as an indicator is not telling us very much. However, when it does speak and is confirmed by other indicators, a loud message is indeed given. Summary. 1. Volume is a totally independent variable from price. 2. It is normal for volume to go with the trend. When these characteristics are present, they have little forecasting value. 3. When volume trends are moving in a direction opposite to that of price, this is abnormal and either warns of an impending trend reversal or emphasizes the significance of any breakout. 4. Volume trends experience exhaustion phenomena. These are called parabolic blow-offs at tops and selling climaxes at lows. Chapter 8. Classic Price Patterns. In earlier chapters, we discussed the concepts of peak and trough progression, support and resistance, trend lines, and rudimentary volume characteristics. These are all basic building blocks of price pattern construction. Now it's time to put them all together to gain a better understanding of how we recognize, interpret, and appreciate the significance of specific formations. For a more complete, in-depth discussion of price patterns, their underlying psychology and significance, please refer to Martin Pring on Price Patterns, McGraw-Hill, 2005. The concept of price patterns is demonstrated in Figures 8.1 and 8.2. Figure 8.1 represents a typical market cycle in which there are three trends: up, sideways, and down. The sideways trend is essentially a horizontal or transitional one, which separates the two major market movements. Sometimes, a highly emotional market can change without warning, as in Figure 8.2, but this rarely happens. Consider a fast-moving train, which takes a long time to slow down and then go into reverse. The same is normally true of financial markets. To the market technician, the transitional phase has great significance because it marks the turning point between a rising and a falling market. If prices have been advancing, the enthusiasm of the buyers has outweighed the pessimism of sellers up to this point, and prices have risen accordingly. During the transition phase, the balance becomes more or less even until finally, for one reason or another, it is tipped in a new direction as the relative weight of selling pushes the trend of prices down. At the termination of a bear market, the reverse process occurs. Major technical principle: Transitions between a rising and a falling trend are often signaled by identifiable trading ranges known as price patterns. These transition phases are almost invariably signaled by clearly definable price patterns or formations, whose successful completion alerts the technician to the fact that a reversal in trend has taken place. This phenomenon is illustrated in Figure 8.3, which shows the price action at the end of a long rising trend. As soon as the price rises above line BB, it is in the transitional area, although this is apparent only sometime after the picture has developed. Once into the area, the price rises to line AA, which is a resistance area. The word resistance is used because, at this point, the price shows opposition to a further rise. When the demand/supply relationship comes into balance at AA, the market quickly turns in favor of the sellers because prices react. This temporary reversal may occur because buyers refuse to pay up for a security, or because the higher price attracts more sellers, or for a combination of these two reasons. The important fact is that the relationship between the two groups is temporarily reversed at this point. Following the unsuccessful assault on AA, prices turn down until line BB, known as a support level, is reached. Just as the price level at AA reversed the balance in favor of the sellers, so the support level BB alters the balance again. This time, the trend moves in an upward direction, for at BB, prices become relatively attractive for buyers who miss the boat on the way up, while sellers who feel that the price will again reach AA hold off. For a while, there is a standoff between buyers and sellers within the confines of the area bounded by lines AA and BB. Finally, the price falls below BB, and a major new downward trend is signaled. To help explain this concept, the contest between buyers and sellers is like a battle fought by two armies engaged in trench warfare. In Figure 8.4, Example A, armies A and B are facing off. Line AA represents Army A's defense, and BB is Army B's line of defense. The arrows indicate the forays between the two lines as both armies fight their way to the opposing trench, but are unable to penetrate the line of defense. In the second example, Army B finally pushes through A's trench. Army A is then forced to retreat and make a stand at the second line of defense, line AA2. In the markets, line AA represents selling resistance, which, once overcome, signifies a change in the balance between buyers and sellers in favor of the buyers, so that prices will advance quickly until new resistance is met. The second line of defense, line AA2, represents resistance to a further advance. On the other hand, Army B might quite easily break through AA2, but the further it advances without time to consolidate its gains, the more likely it is to become overextended, and the greater is the probability of its suffering a serious setback. At some point, therefore, it makes more sense for this successful force to wait and consolidate its gains. If prices extend too far without time to digest their gains, they, too, are more likely to face a sharp and seemingly unexpected reversal. Introducing the rectangle. The transitional or horizontal phase separating rising and falling price trends discussed earlier is a pattern known as a rectangle. This corresponds to the line formation developed from Dow theory. The rectangle in a circumflex Figure 8.5, marking the turning point between the bull and bear phases, is termed a reversal pattern. Reversal patterns at market tops are known as distribution areas or patterns, where the security is distributed from strong, informed acircumflex participants to weak, uninformed ones. And those at market bottoms are called accumulation patterns, where the security passes from weak, uninformed participants to strong, informed ones. In Figure 8.6, we see a completed pattern with a victory for the buyers as the price pushed through line AA. Note that, as the price moves through AA, the series of declining peaks and troughs reverses to one of rising peaks and troughs. On the other hand, in Figure 8.7, the price breaks to the upside, reinforcing the series of rising peaks and troughs that precede the formation of the rectangle, thereby reaffirming the underlying trend. In this case, The corrective phase associated with the formation of the rectangle would temporarily interrupt the bull market. Such formations are referred to as consolidation or continuation patterns. An example of a bearish continuation rectangle is shown in Chart 8.1 for the copper price and Chart 8.2 for the Dow Jones Rail Average. During the period of formation, there is no way of knowing in advance which way the price will ultimately break. Therefore, it should always be assumed that the prevailing trend is in existence until it is proved to have been reversed. Figure 8.8 shows an example of a continuation rectangle that develops in a downtrend. Size and depth. The principles of price pattern construction and interpretation can be applied to any time frame, right from 1-minute bars all the way through to monthly or even annual charts. However, the significance of a price formation is a direct function of its size and depth. Major technical principle: the longer a pattern takes to complete, and the greater the price fluctuations within it, the more substantial the following move is likely to be. Thus, a pattern that shows up on a monthly chart is likely to be far more significant than one plotted with intraday data and so forth. It is just as important to build a strong base from which prices can rise as it is to build a large, strong, deep foundation upon which to construct a skyscraper. In the case of financial market prices, the foundation is an accumulation pattern that represents an area of indecisive combat between buyers and sellers. The term accumulation is used because market bottoms always occur when the news is bad. In markets, such an environment stimulates sales by uninformed investors who are not expecting developments to improve. During an accumulation phase, more sophisticated investors and professionals would be positioning or accumulating the asset, concerned in anticipation of improved conditions for the security in question 6 to 9 months ahead. During this period, the security in question is moving from weak, uninformed traders or investors into strong and knowledgeable ones. At market tops, the process is reversed, as those who were accumulating at or near the bottom sell to less sophisticated market participants, who become more and more attracted as prices rise. For equities, this might develop because business conditions improve and forecasts for the economy are revised upward. Thus, the longer the period of accumulation, the greater the amount of a security that moves from weak into strong hands, and the larger is the base from which prices can rise. The reverse is true at market tops, where a substantial amount of distribution inevitably results in a protracted period of price erosion or base building. Major technical principle: the longer the formation of any pattern takes, and the more often it fails to break through its outer boundaries, the greater is the significance of the ultimate penetration. The time taken to complete a formation is important because of the amount of an asset changing hands, and also because a movement in price beyond the boundaries of a pattern means that the balance between buyers and sellers has altered. When the price action has been in a stalemate for a long time and investors have become used to buying at one price and selling at the other, a move beyond either limit represents a fundamental change, which has great psychological significance. A great example of a very long rectangle is shown in Chart 8.3 for the CRB composite. There was every probability that a breakout from such a pattern would be followed by a good move, but there was no indication that prices would rise so sharply over such a brief period of time. The depth of a formation also determines its significance. Consider the trench warfare analogy once more. If the opposing trenches are very close together, say, within 100 yards, this means that the victorious assault, when it comes, will be less significant than if the armies are separated by several miles. For in that case, the battles will have been much more intense and the victory that much greater. The same is true in the financial markets. The breaching of a wide trading range has far greater psychological significance than does a narrow one. Measuring implications. Most of the results obtained with technical analysis procedures do not indicate the eventual magnitude of a trend. Price patterns are the exception, since their construction offers some limited forecasting possibilities. Pretty well all price patterns obtain measuring objectives from their depth. The rectangle is no exception. Figure 8.9 shows a rectangle that has formed and completed a distribution top. The measuring implication of this formation is the vertical distance between its outer boundaries, i.e., the distance between lines AA and BB projected downward from line BB. In many cases, the price trend will extend beyond the objective. In really strong moves, it will travel in multiples of it. We can take the process a step further by stating that the various multiples of the objective itself can become important potential support and resistance areas in their own right. Time and again, these price objective areas turn out to be important support or resistance points. Unfortunately, there is no way to determine where the actual juncture point will be for any rally or reaction. This emphasizes the principle that in technical analysis, there is no known way of consistently determining the magnitude of a price movement. It is only possible to speculate on the probability that a specific area will prove to be a support or resistance zone. Consequently, while this measuring formula offers a rough guide, it is usually a minimum expectation. Having established the fact that price patterns offer price objectives when completed, it is also important to revisit the options of arithmetic and logarithmic scaling covered earlier. If you recall, arithmetic scaling involves using the same vertical distance for equal point amounts, so that the difference in space between 2 and 4 is the same as that between 20 and 22. This compares to ratio or logarithmic scaling, where the same vertical distance plots the same proportionate move. Thus, for example, 1 inch might represent a 20% price move at whatever level it takes place. The importance of using logarithmic scales whenever possible is shown in figures 8.10 and 8.11. In figure 8.10, the price traced out and broke down from a rectangle. Projecting the vertical distance between 200 and 100 downward gives an objective of 0, clearly a very unlikely possibility. On the other hand, figure 8.11 uses the same projection based on a logarithmic scale. In this case, a more realistic objective of 50 is obtained. It is important to remember that market prices are a function of psychological attitudes toward fundamental events. Since these attitudes have a tendency to move proportionately, it makes sense to plot them on a scale that reflects proportionate moves equally. Clearly, this distinction has little effect on very short-term, 2 to 6 weeks or intraday charts, but since you do not know exactly when it will, it's definitely a good idea to set your charting software to ratio as a default. If a rectangle appears as a bottom reversal pattern, the measuring rules remain consistent with the example given for the distribution formation. The only difference is that we project the objective and multiples of the objective in an upward direction, not downward. The exact same principles also apply to continuation rectangles. Figure 8.12 shows an upside breakout from a rectangle that forms during a bullish trend. Note in this case that the price does not immediately reach its upside objective, but does so after a small rally and reaction. This is why the objective is described by the term ultimate. Most people buy the breakout on the assumption that they will make more or less instant profits as the price moves straight to the objective, but that is not necessarily the case. Major technical principle: a measuring objective is a minimum ultimate objective. In many cases, the price will move beyond the objective. In really strong moves, it will move in multiples of the objective, where the various multiples or the objective itself become important support and resistance areas. Confirmation of a valid breakout. Price. So far, it has been assumed that any move out of the price pattern, however small, constitutes a valid signal of a trend reversal or resumption if the pattern is one of consolidation. Quite often, misleading moves known as whipsaws occur, so it is helpful to establish certain criteria to minimize the possibility of misinterpretation. Conventional wisdom holds that you should wait for a 3% penetration of the boundaries before concluding that the breakout is valid. This filters out a substantial number of misleading moves, even though the resulting signals are less timely. This approach was developed in the first part of the 20th century, when holding periods for market participants were much longer. Today, with the popularity of intraday charts, 3% could represent the complete move, and then some. I have no basic objection to the 3A circumflex euros% rule for longer-term price movements in which the fluctuations are much greater. However, the best approach is a common-sense one based on experience and judgment in each particular case. It would be very convenient to be able to say that anything over a specific percentage amount represents a valid breakout. But unfortunately, a lot depends on the time frame being considered and the volatility of the specific security. For example, electric utilities are very stable in their price action compared to mining stocks, where the volatility is far greater. Applying the same percentage breakout rule to both obviously doesn't make sense. What constitutes a decisive breakout, where the odds of a whipsaw are considerably reduced, is then very much a matter of personal judgment based on experience, trial, and error. This judgment should take into consideration such factors as the type of trend being monitored, the volatility of the security, volume, and momentum characteristics. Another factor that can help early on in deciding if a breakout is valid is the fact that a good breakout should hold for several periods. For example, you may observe a decisive upside breakout from a rectangle on a daily chart, but if it cannot hold for more than one day above the breakout level, the signal is highly suspect. Often, the technical position is worse after such breakouts, because breakouts that cannot hold indicate exhaustion, and exhaustion moves are often followed by strong price trends in the opposite direction to that indicated by the false breakout. On entering any trade or investment based on a price pattern breakout, it is important to decide ahead of time what type of price action would cause you to conclude that the breakout was a whipsaw. In effect, this will be below a support level for an upside breakout and below a resistance zone for a downward one. For this, you can draw on the information contained in Chapter 5 on support and resistance. An example of a false upside breakout might be a penetration of a previous minor low, a decline below a predetermined level from the breakout point, or the rupture of a minor uptrend line. Some possibilities are featured in Figure 8.13. A stop should then be placed below the support level. In this way, you will have calculated the loss you are willing to undertake and the point where the original premise for the trade, i.e., the breakout, is no longer operative. Failure to make such a decision ahead of time will mean that your decision to sell is more likely to be based on emotion and knee-jerk reactions to news events than on a logical preset plan. Retracement moves. A great deal of the time, when the price breaks out from a pattern, the initial thrust is followed by a corrective move back to the upper or lower reaches of the formation, depending on the direction of the breakout. This is known as a retracement move, and it offers an additional entry point, often under substantially less emotional conditions. The retracement serves two functions. First, it helps to correct the excessive emotion associated with the breakout and brings people back to earth. From here, it is then possible for the new trend to extend on a sounder basis. Second, it acts as a test of the breakout. A downside retracement will find support at the breakout point, and an upside retracement will find resistance in the lower boundary of the pattern, as these two zones reverse their former roles. Retracements, then, represent normal price behavior, and although they can be frustrating, are nothing to get concerned about. Indeed, the breakout itself is often a volatile illiquid affair, as one side or the other heads for the entrance or exit, depending on its direction. As a result, orders are often executed with horrendous fills. Price activity during the retracement process, on the other hand, is relatively quieter. This means that buying or selling can be undertaken in a much more controlled environment. Figure 8.14 shows that it is often a good idea to wait for a retracement in a rising trend and buy as the price signals that the retracement is over. Cancellations. If the minimal objective proves to be the ultimate extension of the new trend, a substantial amount of accumulation or distribution, whichever is appropriate, will typically have to occur before prices can move in their previous direction. Thus, a 2-year rectangle might be completed and the downward price objective reached. Even though further price erosion does not take place, it is still technically necessary for a base accumulation of approximately the same size as the previous distribution, in this case, 2 years, to be formed before a valid uptrend can take place. An example is shown in Figure 8.15, where an upside breakout is canceled by a downside one. The word technically has been emphasized because that is not always the case, and there are lots of examples where large distribution formations have been canceled by small ones and vice versa. That means if you can spot a cancellation, pay attention to the signal and look around at the other indicators to see if they agree. If so, go with the cancellation, as it's probably telling the truth. Volume considerations. So far, we have just considered price in our analysis, but volume is an important independent variable that can help us obtain a more accurate reflection of crowd psychology. To quickly recap, volume typically goes with the trend, i.e., it expands with a rising trend of prices and falls with a declining one. This is a normal relationship, and anything that diverges from it should be considered a warning sign that the prevailing price trend may be in the process of reversing. Volume is always measured in relation to the recent past. Thus, heavy volume relates to volume 20 to 30 bars or so ago, not to volume, say, 10 years ago, where institutional changes may have permanently increased the level of activity. Major technical principle: volume is always measured relative to its recent past. In the case of the rectangle, and with most other patterns, it is normal for the trend of volume to contract as the formation develops. Activity may continue to fluctuate along with the price, but with the benefit of hindsight, we would expect to see the various peaks and troughs of volume shrink as the pattern develops, along the lines of Figure 8.16. As it nears completion, disinterest prevails and volume often dries up. The quality of an accumulation formation is certainly improved if volume expands on the upside break. Sometimes, it is even possible to draw a trend line joining the lower volume peaks, as shown in Figure 8.16. It is this upward surge in trading activity that confirms the validity of the breakout because it flags the enthusiasm of buyers. A similar move on low and declining volume would be suspect and would result in its failure to move with the trend. An example is shown in Figure 8.17. In this instance, volume definitely declines as the price is breaking out. Such action typically signals that prices are advancing more on a lack of sellers than strong, enthusiastic buyers. As the price starts to slip, volume picks up noticeably, suggesting that this is happening because of selling pressure. It is a definite sign that increases the possibility that the breakout is a whipsaw. In many instances, you will see charts where successful upside breakouts develop with no obvious change in activity, either on the upside or downside. Unfortunately, this is a fact of life. Thus, a good volume expansion is a desirable but not necessarily a mandatory condition for a valid breakout. It certainly increases the odds, but other indicators such as oscillators could also tip the balance. If volume declines on the breakout, as in Figure 8.17, this is more than a missing piece of positive evidence and is, actually, a negative factor. Figure 8.18 shows a downside breakout from a rectangle. The same shrinking volume characteristics during the development of the pattern are present as for the bullish variety. However, volume characteristics on the breakout are less critical. This is because it is normal for it to contract as prices decline. Thus, contracting volume on a breakdown is perfectly normal. What is not typical, though, is for it to expand on a downside move. This in itself suggests that sellers are more motivated and therefore adds a negative flavor to the pattern. More often than not, prices will reverse and put on a small recovery or retracement rally following the downside breakout, Figure 8.19. This advance is invariably accompanied by declining volume, which itself reinforces the bearish indications. It is halted at the lower end of the rectangle, which now becomes an area of resistance. The same idea of declining volume should accompany a retracement move that follows an upside breakout. Figure 8.20 shows an example where both price volatility and volume shrink dramatically. This combination indicates an extremely fine balance between buyers and sellers that takes place over an extended period. Normally, A price objective is determined by the depth of the formation. In this case, though, the finely balanced supply/demand situation is usually followed by a far greater and sharper move than that indicated by the normal measuring techniques. Figure 8.20 dramatizes a sharp downside breakout, but the principle of rapidly declining volume followed by a huge expansion applies equally as well to an upside breakout. In this instance, volume typically explodes as we move from a situation in which there is virtually no interest by either party to one in which buyers cannot get enough of the security at any price. Such are the ingredients for the start of a dramatic rally. An example is shown in chart 8.4 of the U.S. traded St. Jude Medical, where a very narrow rectangle developed with a dramatic drop in volume. When activity expanded, a short but sharp rally followed. Finally, chart 8.5 features Moser Bear, an Indian stock that shows the formation of a rectangle top. It meets the minimum requirement of trendline touches, so the lines as support or resistance areas are not that significant in themselves. During the formation of the rectangle, the odd day experienced an expansion in volume, but the overall trend is a declining one. The fact that prices fell so sharply after the breakout is testament to the fact that volume does not necessarily have to expand on the downside. Prices can just as easily fall due to a lack of bids. Note also that while the price almost reached 3 times its objective, the level of the actual objective, A, became a resistance area on the way back up. Consequently, it's always a good idea to measure for these objectives at the outset, because you can never be sure where prices might find timely reversal points. A lot of the time, we find price moves following breakouts from consolidation patterns to be quite substantial, often more so than from reversal patterns. That's because reversal patterns need to build up some momentum, whereas momentum was already in place prior to the formation of the consolidation pattern. Major technical principle: volume usually leads price. Head and shoulders. Head and shoulders as reversal patterns. At tops, head and shoulders H and S are probably the most reliable of all chart patterns. They occur at both market tops and market bottoms. Figure A circumflex Euros 8.21 shows a typical head and shoulders distribution pattern. See also chart 8.6. It consists of a final rally, the head separating 2 smaller, although not necessarily identical, rallies, the shoulders. If the 2 shoulders were trends of intermediate duration, the first shoulder would be the penultimate advance in the bull market, and the second the first bear market rally. The head would, of course, represent the final intermediate rally in the bull market. Volume characteristics are of critical importance in assessing the validity of these patterns. Activity is normally heaviest during the formation of the left shoulder and also tends to be quite heavy as prices approach the peak. The real tip-off that an H and S pattern is developing comes with the formation of the right shoulder, which is invariably accompanied by distinctly lower volume. Quite often, the level of volume contracts as the peak of the right shoulder is reached. The line joining the bottoms of the 2 shoulders is called the neckline. If you look carefully at figure 8.21, you will appreciate that the violation of the neckline also represents a signal that the previous series of rising peaks and troughs has now given way to at least one declining peak and trough. The right shoulder represents the first lower peak and the bottom of the move following the breakdown, a lower trough. The measuring formula for this price formation is the distance between the head and the neckline projected downward from the neckline, as shown in figure 8.21. It follows that the deeper the pattern, the greater its bearish significance once it has been completed. Sometimes, a head and shoulders completion will be followed by a fairly extensive downtrend. At other times, the negative effect of the pattern will be quickly canceled by the completion of a base. Often, traders will observe the formation of a head and shoulders top and anticipate a breakdown. This is an incorrect tactic based on this evidence alone, because it is not known until later whether the prevailing trend will continue, or if a reversal signal will be given with a decisive break below the neckline. Over the years, I have seen many analysts who should know better forecast a bearish trend based on an incomplete head and shoulders top. Remember, in technical analysis, the prevailing trend is assumed to be in force until the weight of the evidence proves otherwise. An incomplete head and shoulders is not evidence, just a possible scenario. Moreover, since a right shoulder rally should be accompanied by a trend of shrinking volume, one that develops under the context of heavy volume provides a clue that the top will fail. H&S patterns can be formed in 10 to 15 minutes or can take decades to develop. Generally speaking, the longer the period, the greater the amount of distribution that has taken place, and therefore, the longer the ensuing bear trend is likely to be. The larger H&S formations are often very complex and comprise several smaller ones, as shown in Figure 8.22. The H&S patterns illustrated in Figures 8.21 and 8.22 have a horizontal neckline, but there are many other varieties, as Figure 8.23 shows, all of which possess the same bearish implications as the horizontal variety once they have been completed. Chart 8.6 shows a classic H&S pattern that formed in the middle of 1928. At bottoms, Figure 8.24 shows an H&S pattern at a market bottom. This is usually called an inverse H&S, a reverse H&S, or an H&S bottom. Normally, volume is relatively high at the bottom of the left shoulder and during the formation of the head. The major factor to watch for is activity on the right shoulder, which should contract during the decline to the trough and expand substantially on the breakout, see Chart 8.7. That's an ideal situation, but it is surprising how many successful breakouts develop under circumstances where the volume does not expand noticeably. If it contracts on the breakout rally, that is a definite no-no and is a strong sign that the breakout is likely to fail. Like the H&S distribution patterns, the inverse accumulation H&S can have a number of variations in trendline slope, number of shoulders, etc. Usually, the more complex the formation, the greater its significance. This goes back to the idea that price formations represent battles between buyers and sellers. The more battles that take place, i.e., the greater the complexity, the more significant the new trend once the battle has been resolved. Some of these reverse head and shoulders variations are shown in Figure 8.25. H&S patterns are extremely reliable formations, and their successful completion usually gives an excellent indication of a trend reversal. H&S formations as continuation patterns. H&S and reverse H&S formations occasionally show up on the charts as continuation patterns. Measuring implications and volume characteristics are the same as for the reversal type. The only difference is that these patterns develop during a trend rather than at the end. Chart 8.8, featuring AEP Industries, shows a great example of a continuation reverse head and shoulders, complete with a huge expansion of volume just before and just after the breakout. Substantial markup phases such as this are not uncommon following these continuation formations. Head and shoulders failures. We have already established that prices are determined by crowd psychology. Individuals can and do change their minds, so can crowds and therefore markets. As a result, what might appear to be a perfectly valid head and shoulders breakout one day may well turn out to be a whipsaw the next. This is generally not the case, but any trader or investor who does not recognize the ability of markets to reverse otherwise perfectly legitimate signals is in a state of delusion. The first step is to make sure that the pattern you are following is indeed a legitimate formation. For example, the price action may exhibit all the characteristics of an H&S distribution pattern, but the price refuses to penetrate the neckline. We have already established that, until the formation is completed with a decisive break below the neckline, it is not a true pattern. This is because the neckline represents a support area, and support has not been violated. In the case of a horizontal formation, failure to penetrate the neckline also means that the series of rising peaks and troughs is still intact. Chart 8.9 features a reverse head and shoulders for Albertsons that did not work. The price rallied up to the solid neckline for a final time in mid-2002, but was unable to push through. The dashed trend line is there to indicate that the final part of the head and the potential inverse right shoulder actually formed a head and shoulders top. Often, it is possible to spot these technical situations where the glass is half full or half empty. In this case, it was half empty, and the price declined. Failures used to be fairly rare, but they now appear to be more common, which indicates the necessity of waiting for a decisive breakout on the downside, or the upside in the case of a reverse head and shoulders. They typically develop when the pattern suggests a break in the opposite direction to the then prevailing trend. Obviously, if this is the actual top or bottom, the formation will be valid. However, when a head and shoulders top forms in a bull market and does not experience a meaningful decline, this will tend to be a countercyclical signal. In fact, the very failure of the pattern may be interpreted as a sign that the prevailing dominant trend probably is still in force. There are several points in the chart where the probabilities of a valid signal sink below 50%, and those of an outright failure start to increase. Figures 8.26 and 8.27 try to address these points. Point A in figure 8.26 represents the bottom following the break below the neckline. The next rally, which ends at B, is a perfectly typical development because retracements are a normal and indeed healthy phenomenon. The price then falls to C, and something unexpected happens. Instead of A circumflex following through on the downside, as would be expected from a head and shoulders top, the price rises back to the neckline again. This is the first sign that things may not work out as expected. When the price once again rallies back above the neckline D, the odds of a failure increase. The balance tips more to the bullish side when the price moves above the downtrend line joining the head with the right shoulder E. This is probably the time to cover all shorts, since the reason for going short in the first place, i.e., the breakdown, no longer exists. The nature of the trend line will have a great deal to do with the change in probabilities. For example, if the line is steep and has been touched only twice, it will have nowhere near as much significance as it would if it were shallow and had been touched several times. A refresher on trendline interpretation in Chapter 6 would be a good idea at this point. The next line of defense is the right shoulder. If the price can rally above this point F, then in some cases, it will now be experiencing a series of rising peaks and troughs. Finally, when the price moves above the head, the pattern is canceled beyond a reasonable doubt. If action on the long side is contemplated, it should be taken either when the price breaks above the trend line joining the head and the right shoulder line E, or when it breaks above the right shoulder F on heavy volume. Usually, such signals offer substantial profits in a very short period of time and are well worth acting on. Again, some common sense comes into play, for if the trend line joining the head and the right shoulder is unusually steep and has been touched only twice, it will not have the authority of a shallower trend line that has been touched or approached on numerous occasions. Inverse H and S patterns can also fail, as we see from figure 8.27. Again, the failure is usually followed by a fairly lengthy decline as participants who bought in anticipation of an upward breakout are flushed out when the new bearish fundamentals become more widely known. Note that the line joining the head with the right shoulder is more significant in this example than that in figure 8.26. That's because the line is shallower and has been touched on more occasions. The joint break with the neckline is also impressive and would greatly increase the odds of a failed pattern. The move below F obviously puts the issue beyond any reasonable doubt. Chart 8.10 shows a failed head and shoulders top for Andrew Corp. This one developed during a very strong linear bull market. The first indication of failure would have been given when the price broke back above the neckline after forming a small base. The clincher developed when the dashed trend line joining several rally peaks was bettered on the upside. Failed patterns are often followed by dynamic moves in the opposite direction to that indicated by the pattern. The rationale for this lies in the fact that market participants who bought or sold short, depending on the direction of the whipsaw, are caught on the wrong side of the market and are forced to liquidate. As a result, false moves should be viewed not with fear, but as an opportunity for profits. The degree of opportunity will depend on the strength of the signal and the closeness at which a realistic stop can be placed, the perceived risk. In this case, the trend line was a very strong one, and a stop could have been placed just below the low of the breakout day. Provided it was bought pretty close to the breakout point, this would have represented a very low risk, potentially high reward trade. Major technical principle: if a technical signal is going to fail, it is often because it is taking place in the opposite direction to the main trend. Double tops and bottoms. A double top consists of two peaks separated by a reaction or valley in prices. Its main characteristic is that the second top is formed with distinctly less volume than the first. See Figure 8.28 and Chart 8.11. It is normal for both peaks to form at the same price level, but it is also possible for the second peak to slightly exceed the first or to top out just a little below it. Remember, this is not an exact science but a common-sense interpretation of a battle between buyers and sellers. Minimum downside measuring implications for double tops, as shown in Figure 8.28, are similar to H and S patterns. A double bottom is shown in Figure 8.29. This type of pattern is typically accompanied by high volume on the first bottom, very light volume on the second, and very heavy volume on the breakout. Usually, the second bottom is formed above the first, but these formations are equally valid whether or not the second reaction reaches, or even slightly exceeds the level of its predecessor. Double patterns may extend to form triple tops or bottoms, or sometimes even quadruple or other complex formations. Some variations are shown in Figure 8.30. In some instances, it may be difficult to differentiate between a head and shoulders, rectangle, or triple top and bottom. That is not important. What is important is the fact that such formations represent a battle between buyers and sellers. When one side or the other wins out with a reversal in the peak/trough progression or the violation of a trend line, that's what is significant. Remember, we give these patterns specific names for identification purposes. If a formation, say, breaks in a bearish way, it does not matter what you call it. It's bearish and likely to lead to lower prices. That's really the lesson to take home. Major technical principle: ultimately, it does not matter what you call a pattern. The important thing is whether it has bullish or bearish characteristics. The measuring implications of all these patterns are derived by calculating the distance between the peak, trough, and lower, upper end of the pattern, and projecting this distance from the neckline. Chart 8.12 shows a classic double bottom in the GIA in 1974 and 1962. Broadening formations. Broadening formations occur when a series of three or more price fluctuations widen out in size, so that peaks and troughs can be connected with two diverging trend lines. The easiest types of broadening formations to detect are those with a flattened bottom or top, as shown in examples A and B in Figure 8.31. The patterns in Figure 8.31 are sometimes referred to as a right-angled broadening formation. Since the whole concept of widening price swings suggests highly emotional activity, volume patterns are difficult to characterize, though at market tops, volume is usually heavy during the rally phases. The patterns at both bottoms and tops are similar to the H and S variety, except that the head in the broadening formation is always the last to be formed. A bear signal comes with a decisive downside breakout. Volume can be heavy or light, but additional negative emphasis arises if activity expands at this point. Since a broadening formation with a flattened top is an accumulation pattern, volume expansion on the breakout is an important requirement, as shown in Example B in Figure 8.31. Examples of broadening formations are shown in Chart 8.13 for W. Granger and Chart 8.14 for the copper price. Notice how the bearish one exceeded its price objective by 3 times. That third multiple proved to be the end of the decline, following which a bullish broadening formation was formed. The power of these patterns can also be appreciated from Chart 8.14, which shows the formation of another right-angled pattern coming off the 2009 bottom. These two types of broadening formations can also develop as consolidation patterns. A bullish one is featured in Figure 8.32. Broadening formations occasionally fail to work. Possibilities are shown in Figure 8.33. Unfortunately, there does not appear to be a reliable point beyond which it is safe to say that the pattern has failed to operate. The best defense in such cases is to extend the diverging trend lines, i.e., the dashed lines in Figure 8.33, and await a decisive penetration by the price as confirmation. When completed, right-angled broadening formations of both the reversal and the continuation type result in a particularly dynamic move. It is almost as if they are aborted H and S formations in which the move is so powerful that there is not time to complete the right shoulder. An example of a bullish right-angled broadening formation, where the price objective was achieved multiple times, is shown in Chart 8.15 for Patni computers. A variation on the right-angled broadening formation is the broadening wedge. These patterns are similar in that they consist of two diverging trend lines, but instead of one of them being constructed at an angle of 90 degrees, it slopes up or down in the case of a bullish pattern, but at a smaller angle of ascent-descent, as shown in Figures 8.34 and 8.35. The measuring implications and other characteristics are identical to those of the right-angled variety. The final type of broadening formation, known as an orthodox broadening top, is shown in Figure 8.36. This pattern comprises three rallies, with each succeeding peak higher than its predecessor, and each peak separated by two bottoms, with the second bottom lower than the first. Orthodox broadening formations are associated with market peaks rather than market troughs. These patterns are extremely difficult to detect until some time after the final top has been formed, since there is no clearly definable level of support where the violation of which could serve as a benchmark. The violent and emotional nature of both price and volume swings further compounds the confusion and increases the complexity of defining these situations. Obviously, a breakout is difficult to pinpoint under such conditions, but if the formation is reasonably symmetrical, a decisive move below the descending trend line joining the two bottoms, or even a decisive move below the second bottom, usually serves as a timely warning that an even greater decline is in store. Measuring implications are similarly difficult to determine, but normally, the volatile character of a broadening top formation implies the completion of a substantial amount of distribution. Consequently, price declines of considerable proportion usually follow the successful completion of such patterns. The problem is that they are quite rare and do not show up on the charts very often. Triangles. Triangles, the most common of all the price patterns discussed in this chapter, are unfortunately the least reliable. They may be consolidation or reversal formations and fall into two categories, symmetrical and right-angled. Symmetrical triangles. A symmetrical triangle is composed of a series of two or more rallies and reactions in which each succeeding peak is lower than its predecessor, and the bottom from each succeeding reaction is higher than its predecessor. See Figure 8.37. A triangle is, therefore, the opposite of a broadening formation, since the trend lines joining peaks and troughs converge, unlike the orthodox broadening formation, in which they diverge. These patterns are also known as coils, because the fluctuation in price and volume diminishes as the pattern is completed. Finally, both price and usually volume react sharply, as if a coil spring had been wound tighter and tighter and then snapped free as prices broke out of the triangle. Circumflex, generally speaking, triangles seem to work best when the breakout occurs somewhere between 1/2 and 3/4 of the distance between the widest peak and rally and the apex, as in Figure 8.38. The volume rules used for other patterns are also appropriate for triangles. Another factor that affects reliability emanates from one of the principles of determining trendline significance. While a triangle can theoretically be constructed by joining 4 turning points, 2 for each line, it follows that those lines will gain greater significance if touched or approached on more numerous occasions. Consequently, when they are eventually violated, their more formidable role as a dynamic support/resistance zone will likely result in a more trustworthy signal. Major technical principle. The more times the lines forming a triangle have been touched or approached, the greater the probability that their eventual violation will be valid. Right-angled triangles. Right-angled triangles are really a special form of the symmetrical type, in that one of the two boundaries is formed at an angle of 90 degrees, i.e., horizontal to the vertical axis. An example is illustrated in Figure 8.39. The symmetrical triangle does not give an indication of the direction in which it is ultimately likely to break, but the right-angled triangle does, with its implied level of support or resistance and contracting price fluctuations. One difficulty in interpreting these formations is that many rectangles begin as right-angled triangles. Consequently, a great deal of caution should be used when evaluating these elusive patterns. An example is shown in Figure 8.40, where a potential downward-sloping right-angled triangle in Example A develops into a rectangle in Example B. Traditionally, measuring objectives for triangles are obtained by drawing a line parallel to the base of the triangle through the peak of the first rally. This line, BB in Figure 8.41, represents the objective that prices may be expected to reach or exceed. The reverse procedure at market tops is shown in Figure 8.41, examples C and D. The same technique is used to project prices when triangles are of the consolidation variety. However, in my own experience, I have not found this method to be particularly useful. I prefer, instead, to treat the triangle as with any other pattern by calculating its maximum depth and then projecting this distance at the breakout. An example of this alternative method is shown in Figure 8.42. An example of a right-angled triangle followed by a bullish broadening formation is shown in Chart 8.16 featuring the GIA cup with a handle. This pattern has been made famous by William O'Neill and is described in his How to Make Money in Stocks, McGraw-Hill, 1995. The pattern develops as a bullish one, usually in a continuation format. Figure 8.43 shows that it takes the form of a big U, the cup, followed by a rally and a small rounding platform, the handle. The cup is typically preceded by a very strong rally, so the left side reflects aggressive profit-taking. The left part of the cup usually marks the culmination of a strong rally and is often associated with heavy volume. The bottom of the cup can take the form of a rounding bottom, as in Figure 8.43, or some ranging action, as in Figure 8.44. The next step in the development of this pattern is a rally on expanding volume, followed by a period of profit-taking in which both volume and price go quiet. Finally, the handle is completed and prices explode to the upside. If it is going to fail, the signal to look for is a break below the lower part of the handle. If the price eventually breaks above the upper level of the handle, the situation will again become bullish. Any breakouts that develop with shrinking volume, though, should be regarded with suspicion. Chart 8.17 shows a cup with a handle formation for ADC Telecom. The breakout above the handle is not accompanied by much of an expansion in volume, but the price certainly doesn't suffer. By its very nature, the cup with a handle is a consolidation formation. Since the breakout follows a shakeout move, the left part of the cup, it is often followed by a very strong rally. Summary. 1. Prices in financial markets move in trends. A reversal is characterized by a temporary period in which the enthusiasm of buyers and sellers is roughly in balance. This transitional process can usually be identified by clearly definable price patterns, which, when completed, offer good and reliable indications that a reversal in trend has taken place. 2. Until a pattern has been formed and completed, the assumption should be that the prevailing trend is still operative, i.e., that the pattern is one of consolidation or continuation. This principle is more important when the trend has been in existence for only a relatively short period, because the more mature it is, the greater the probability of an important reversal. 3. Price patterns can be formed over any time period. The longer the time required to form a pattern and the greater the price fluctuations within it, the more substantial the ensuing price movement is likely to be. 4. Measuring formulas can be derived for most types of patterns, but these are generally minimum objectives. prices usually extend much further. 5. Price objectives represent the minimum ultimate target and are not normally achieved in one move. Usually, a series of rallies and reactions in an upside breakout is required, or reactions or retracements in a downside breakout, before the objective is reached. Chapter 9. Smaller price patterns and gaps. Most of the price patterns described in Chapter 8 can be observed in both reversal and continuation formations. The majority of the formations discussed in this chapter materialize during the course of a price trend and are, therefore, of the continuation variety. Since many of them are reflections of controlled profit-taking during an advance and controlled digestion of losses during a decline, these patterns, for the most part, take a much smaller time to form than those described in the previous chapter. They most commonly appear in the daily charts. Flags. A flag, as the name implies, looks like a flag on the chart. It represents a quiet pause accompanied by a trend of declining volume, which interrupts a sharp, almost vertical rise or decline. As the flag is completed, prices break out in the same direction that they were moving in prior to its formation. Flags for both an up and a down market are shown in Figure 9.1. Essentially, they take the form of a parallelogram in which the rally peaks and reaction lows can be connected by two parallel lines. The lines move in a countercyclical direction. In the case of a rising market, the flag is usually formed with a slight downtrend, but in a falling market, it has a slight upward bias. Flags may also be horizontal. In a rising market, this type of pattern usually separates two halves of an almost vertical rise. Volume is normally extremely heavy just before the point at which the flag formation begins. As it develops, volume gradually dries to almost nothing, only to explode as the price works its way out of the completed formation. Flags can form in a period as short as 5 days or as long as 3 to 5 weeks. Essentially, they represent a period of controlled profit-taking in a rising market. The development of the flag in a downtrend is also accompanied by declining volume. This type of flag represents a formation with an upward bias in price, so the volume implication is bearish in nature, i.e., rising price with declining volume. When the price breaks down from the flag, the sharp slide continues. Volume tends to pick up as the price slips below the flag's lower boundary, but it need not be explosive. Only upside breakouts in bull markets require this characteristic. It is important to make sure that the price and volume characteristics agree. For example, the price may consolidate following a sharp rise in what appears to be a flag formation, but volume may fail to contract appreciably. In such cases, great care should be taken before coming to a bullish conclusion, since the price may well react on the downside. A flag that takes more than 4 weeks to develop should also be treated with caution because these formations are, by definition, temporary interruptions of a sharp uptrend. A period in excess of 4 weeks represents an unduly long time for profit-taking, therefore, holds a lower probability of being a true flag. Flag formations are usually reliable patterns from a forecasting point of view, for not only is the direction of ultimate breakout indicated, but the ensuing move is also usually well worthwhile from a trading point of view. Flags seem to form at the halfway point of a move. Once the breakout has taken place, a useful method for setting a price objective is to estimate the size of the price move in the period immediately before the flag formation began, and then to project this move in the direction of the breakout. In technical jargon, flags in this sense are said to fly at half-mast, i.e., halfway up the move. Since flags take a relatively short period to develop, they do not show up on weekly or monthly charts. Chart 9.1, featuring Adaptec, shows a flag together with the measuring implications as shown with the 2 dashed arrows. Pennants. A pennant develops under exactly the same circumstances as a flag and has similar characteristics. The difference is that this type of consolidation formation is constructed from 2 converging trend lines, as shown in Figure 9.2. In a sense, the flag corresponds to a rectangle and the pennant to a triangle because a pennant is, in effect, a very small triangle. The difference between them is that a triangle consists of a trading range bound by two converging trend lines that point in different directions. In the case of a pennant, they both move in the same direction. If anything, volume tends to contract even more during the formation of a pennant than during that of a flag. In every other way, however, pennants are identical to flags in terms of measuring implication, time taken to develop, volume characteristics, etc. Chart 9.2 features a pennant for Adobe in an upmarket. Note how the volume shrinks during the formation of the pattern. It then expands on the breakout. Wedges. A wedge is very similar to a triangle, in that two converging lines can be constructed from a series of peaks and troughs, as shown in Figure 9.3. But whereas a triangle consists of one rising and one falling line, or one horizontal line, the converging lines in a wedge both move in the same direction. A falling wedge represents a temporary interruption of a rising trend, and a rising wedge is a temporary interruption of a falling trend. It is acircumflex normal for volume to contract during the formation of both types of wedges. Since wedges can take anywhere from 2 to 8 weeks to complete, they sometimes occur on weekly charts, but are too brief to appear on monthly charts. Rising wedges are fairly common as bear market rallies. Following their completion, prices usually break very sharply, especially if volume picks up noticeably on the downside. The wedge and the pennant are very similar, since they both consist of converging trend lines that move in a contra-trend direction. The difference is that the breakout point of a pennant forms very close to or even right at the apex. The two projected lines for the wedge, on the other hand, would meet way in the future, in many instances, literally off the charts. Figure 9.4 puts us straight on this one, as you can see that the projected dashed lines for the wedge meet well after the breakout point. Compare this to the pennant, which is much more akin to a triangle. Sometimes, the difference between these two formations is hard to judge. If anything, wedges generally appear to take longer to form than pennants. As stated in the previous chapter, it really does not matter what we call these formations. The important question is whether their characteristics and volume configurations are bullish or bearish. Chart 9.3 shows a bearish wedge for Yahoo. Usually, such formations develop after a more protracted decline than that shown in the chart. However, there can be no mistaking the narrowing trading range as it was formed. The shrinking activity during the formation of the pattern and subsequent increase in volume on the breakout confirmed its bearish nature. Saucers and rounding tops. Figure 9.5 shows the formation of a saucer and a rounding top. A saucer pattern occurs at a market bottom, while a rounding top develops at a market peak. A saucer is constructed by drawing a circular line under the lows, which roughly approximates an elongated or saucer-shaped letter U. As the price drifts toward the low point of the saucer and investors lose interest, downward momentum dissipates. This lack of interest is also characterized by the volume level, which almost dries up at the time the price is reaching its low point. Gradually, both price and volume pick up, until eventually, each explodes into an almost exponential pattern. The price action of the rounded top is exactly opposite to that of the saucer pattern, but the volume characteristics are the same. As a result, if volume is plotted below the price, it is almost possible to draw a complete circle, as shown in Figure 9.6. The tip-off to the bearish implication of the rounded top is the fact that volume shrinks as prices reach their highest levels and then expands as they fall. Both these characteristics are bearish and were discussed in greater detail in Chapter 7. Rounding tops and bottoms are fine examples of a gradual change over in the demand/supply balance that slowly picks up momentum in the direction opposite to that of the previous trend. Quite clearly, it is difficult to obtain breakout points for these patterns since they develop slowly and do not offer any clear support or resistance levels on which to establish a potential benchmark. Even so, it is worth trying to identify them since they are usually followed by substantial moves. Rounding and saucer formations can also be observed as consolidation as well as reversal phenomena and can take as little as 3 weeks to as much as several years to complete. Gaps. An upside gap occurs when the lowest price of a specific trading period is above the highest level of the previous trading period. A downside gap develops when the highest price for a specific trading period is below the lowest price of the previous trading period. On a daily bar chart, the trading period is regarded as a day, whereas on a weekly chart, it is a week, etc. By definition, gaps can occur only on bar charts on which intraday, weekly, or monthly prices are plotted. A gap is represented by an empty vertical space between one trading period and another. Daily gaps are far more common than weekly ones because a gap on a weekly chart can fall only between Friday's price range and Monday's price range, i.e., it has a 1 in 5 chance relative to a daily chart. Monthly gaps are even rarer, since such holes on the chart can develop only between monthly price ranges. The most common place to find gaps are on intraday charts at the open. I will have more to say on that point later. A gap is closed or filled when the price comes back and retraces the whole range of the gap. On daily charts, this process sometimes takes a few days, and at other times it takes a few weeks or months. In rare cases, the process is never completed. Major technical principle. There is an old saying that the market abhors a vacuum, which means that most gaps are eventually filled. It is certainly true that almost all gaps are eventually filled, but this is not always the case. Because it can take months or even years to fill a gap, trading strategies should not be implemented solely on the assumption that the gap will be filled in the immediate future. In almost all cases, some kind of attempt is made to fill it, but quite often, a partial filling on a subsequent test is sufficient before the price again reverts to the direction of the prevailing trend. The reason why most gaps are closed is that they are emotional affairs and reflect traders who have strong psychological motivation. We could even say excess fear or greed, depending on the direction of the trend. Decisions to buy or sell at any cost are not objective ones, which means the odds of people having second thoughts when things have cooled down are pretty high. The second thoughts in this case are represented by the closing of the gap, or at least a good attempt at closing it. Gaps should be treated with respect, but their importance should not be overemphasized. Those that occur during the formation of a price pattern, known as common gaps or area gaps, are usually closed fairly quickly and do not have much technical significance. Another type of gap which has little significance is the one that results from a stock going ex-dividend. There are 3 other types of gaps that are worthy of consideration: breakaway, runaway, and exhaustion gaps. Breakaway gaps. A breakaway gap is created when a price breaks out of a price pattern, as in figures 9.7 and 9.8. Generally speaking, the presence of the gap emphasizes the bullishness or bearishness of the breakout, depending on which direction it takes. Even so, it is still important for an upside breakout to be accompanied by a relatively high level of volume. It should not be concluded that every gap breakout will be valid, because the sure thing does not exist in technical analysis. However, a gap associated with a breakout is more likely to be valid than one that does not. Gap breakouts, which occur on the downside, are not required to be accompanied by heavy volume. If a gap does turn out to be a whipsaw, then this will usually be signaled sooner rather than later. Since most gaps are filled, and there is rarely a reason why you have to buy, it could be argued that it is better to wait for the price to at least attempt to fill the gap before committing money. After all, if you miss out because the price does not experience a retracement, all you have lost is an opportunity. Certainly, you will experience some frustration, but at least you will not have lost any capital. With markets, there is always another opportunity. If you have the patience and the discipline to wait for that opportunity, you will be much better off in the long run. The problem, especially in this day and age of shrinking time spans, is that most of us are not blessed with the patience and discipline that we so badly require for successful trading and investing. The danger of buying on a gap breakout is that you will get caught up in the emotions of the crowd. This buy-at-any-cost mentality is likely to result in discouragement when the price inevitably retraces to the downside as emotions calm down. The advice is not that you should never buy a gap breakout, but that you should think very carefully and mentally prepare yourself for the high probability that the price will correct, thereby placing your position temporarily underwater. Breakaway gaps that develop during the early stages of a primary bull market are more likely to be valid than those that develop after a long price advance. This is because young bull markets have a tremendous amount of upside momentum. Under such circumstances, there is less likelihood of indecisiveness being reflected in the charts in the form of retracement moves and trading ranges. On the other hand, breakaway gaps that develop at the end of a bull move are more likely to indicate emotional exhaustion, as the sold-out bulls literally give up on any possibility of being able to buy again at lower prices. The same principle in reverse applies to bear trends. In Technical Analysis of Stock Trends, CRC Press, 2012, Edwards and Maggi have a slightly different take. Their advice about whether to buy a breakaway gap rests on the volume configuration. They state that if volume is high just prior to the gap and shrinks as the price moves away from the upper part of the gap, then there is a 50-50 chance of a retracement. On the other hand, if volume expands at the upper part of the gap as prices move away from it, then the odds of a retracement or gap closing effort are substantially less. Such characteristics, they imply, should be bought into. I think this can be taken a little further by setting a 3-step rule for buying breakout gaps. A theoretical example is shown in Figure 9.8. First, it's important for the gap to develop at the beginning of a move, which implies that it should be preceded by at least an intermediate decline. In other words, if a gap is to represent a sustainable change in psychology, it must have some pretty bearish psychology as witnessed by the preceding decline to reverse. Second, the gap day should be accompanied by exceptionally heavy volume. This again reflects a change in psychology because the bulls are very much in control. Third, an attempt to close the gap should be made within 2 to 4 days, and the price should take out the high of the day of the gap. If an attempt to close the gap fails, so much the better. The idea of the test is that market participants have had a chance to change their bullish minds and did not. The part of the rule about the new high is really a way of determining whether the market confirms the gap following the successful test. Chart 9.4 offers 2 examples of this in October 1993 and, to a lesser extent, in February 1994. Continuation or runaway gaps. Runaway gaps occur during a straight-line advance or decline when price quotations are moving rapidly and emotions are running high. Either they are closed very quickly, e.g., within a day or so, or they tend to remain open for much longer periods and are not generally closed until the market makes a major or intermediate swing in the opposite direction to the price movement that was responsible for the gap. This type of gap often occurs halfway between a previous breakout and the ultimate duration of the move. For this reason, continuation gaps are sometimes called measuring gaps. See Figure 9.9, examples A and B. Chart 9.5 shows this concept in action as the measuring gap develops about halfway through the late August/September advance. Exhaustion gaps. A price move sometimes contains more than one runaway gap. This indicates that a very powerful trend is in force, but the presence of a second or third gap should also alert the technician to the fact that the move is likely to run out of steam soon. Hence, there is a possibility that a second or third runaway gap will be the final one. An exhaustion gap is, therefore, associated with the terminal phase of a rapid advance or decline, and is the last in a series of runaway gaps. See Figure 9.9 example B and Figure 9.10. One clue that an exhaustion gap may be forming is a level of volume that is unusually heavy in relation to the price change of that day. In such a case, volume usually works up to a crescendo well above previous levels. Sometimes, the price will close near the vacuum or gap and well away from its extreme reading. If the next day's trading creates an island on which the gap day is completely isolated by a vacuum from the previous day's trading, this is usually an excellent sign that the gap day was, in fact, the turning point. This indicates only temporary exhaustion, but should be a red flag that signals to highly leveraged traders that they should liquidate or cover their positions. If the gap is the first one during a move, it is likely to be a runaway rather than a breakaway type, especially if the price objective called for by a price pattern has not yet been achieved. An exhaustion gap should not be regarded as a sign of a major reversal, but merely as a signal that, at the very least, some form of consolidation should be expected. The importance of gaps as emotional points. The places where gaps start or terminate are potential pivotal points on a chart because they represent high emotion. If you have an argument with a friend and one of you shouts loudly at one point, you will both tend to remember that particular moment because it represents an emotional extreme. The same principle can be applied to technical analysis, since charts are really a reflection of psychological attitudes. Major technical principle. Gaps have the potential to become important support resistance levels that have the power to reverse short-term trends. Just as people have a tendency to revisit their emotions after a heated debate, so do prices after an emotional gap move. Gaps on intraday charts. There are really two types of opening gaps in intraday charts. The first develops as prices open beyond the trading parameters of the previous session, as in chart 9.6. I'll call these classic gaps since these are the ones that also appear on the daily charts. The second, more common gap develops only on intraday charts as the opening price of a new day gaps well away from the previous circumflex session's closing bar. I'll call these gaps intra-bar gaps because they only fall between two bars calculated on an intraday time frame. For example, in chart 9.7, the price opened up higher and created a gap at a. However, if you look back, you will see that the trading range of the previous day, contained within the box on the left, was not exceeded at the opening price. Thus, on a daily chart, there would have been no gap. If you are a trader with a 2 to 3 week time horizon using intraday charts, you should approach gaps in a different way than if you have a 1 or 2 day time horizon. The first category should try to avoid initiating trades at the time the gap is created. This is because almost all gaps are eventually closed. Sometimes this happens within a couple of hours, and at other times it can take 2 or 3 weeks. Consequently, if you buy on an opening gap on the upside, as in this chart, you run the risk that it will soon be closed. The problem is that you do not know whether it will be 2 days or 4 weeks. Intraday opening gaps. Intraday traders are also advised to step aside when the market opens sharply higher or lower. In the case of stocks, this is caused by an order imbalance. This means that the market makers are forced to go short so that they can satisfy the unfilled demand. They naturally try to get the price a little higher at the opening so that it will come down a little, enabling them to cover all or part of the short position. The process will be reversed in the case of a lower opening. The key, then, is to watch what happens to the price after the opening range. Normally, if prices work their way higher after an upside gap and opening trading range, this sets the tone of the market for at least the next few hours, often longer. On the other hand, if the price starts to close the gap after a few bars, then the tone becomes a negative one. In chart 9.8, featuring the now no longer listed Merrill Lynch, there is an opening gap on the Wednesday. After a bit of backing and filling, the price gradually works its way lower throughout the day. The signal that the opening could be an aberration developed after the price slipped below trendline A. Note how the trendline proved to be resistance for the rest of the session. Thursday again sees an opening gap, but this time, there is very little in the way of a trading range since the price continues to climb. Again, the rally away from the opening bar set the tone for the rest of the day. Later, on Friday, another gap appears, but this time, the opening trading range is resolved on the downside as the price breaks below the $83 level flagged by the line. Once again, this proves to be resistance for the rest of the day. Island reversals. An island reversal is a compact trading range created at the end of a sustained move and isolated from previous price behavior by an exhaustion gap and a breakaway gap. A typical island reversal is shown in Figure 9.10 and Chart 9.9. The island itself is not usually a pattern denoting a major reversal. However, islands often appear at the end of an intermediate or even a major move and form part of an overall price pattern, such as the top or bottom of a head and shoulders H and S pattern, or an inverse H and S pattern. Islands occasionally occur as one-day phenomena, as is also shown in Chart 9.9. Summary. 1. Flags, pennants, and wedges are short-term price patterns that usually develop halfway along a sharp price movement. Their development is normally complete within 3 weeks on a daily chart, and they represent periods of quiet price movement and contracting volume. They are almost always continuation patterns. 2. Saucer formations and rounding tops are usually reversal patterns and are typically followed by substantial price movements. In both formations, volume contracts toward the center and is at its highest at either extremity. 3. A gap is essentially a vacuum or hole in a bar chart. Ex-dividend and area gaps have little significance. Breakaway gaps develop at the beginning of a move, runaway gaps in the middle of a move, and exhaustion gaps at the end. 4. The upper and lower areas of gaps represent potentially significant support and resistance areas. 5. Island reversals are small price patterns or congestion areas isolated from the main price trend by 2 gaps. They often signal the termination of an intermediate move. Chapter 10. 1 and 2 bar price patterns. The price patterns we have considered so far take some time to complete, usually at least 20 bars. They all reflect changes in the relationship between buyers and sellers, which tells us that there has been a reversal in psychology. Major technical principle 1 and 2 bar patterns reflect changes in psychology that have a very short-term influence on prices. Historically, the patterns described in this chapter were called 1 and 2 day patterns or 1 and 2 week patterns. With the advent of intraday charts, the title inside days, outside days, etc., is no longer a generic term. Therefore, I have chosen to use the term bar to refer to these patterns, since that term applies to all charts from 1-minute bars up to monthly ones. For a more in-depth discussion on these fascinating patterns, please see Martin Pring on price patterns. We have already established that a key factor influencing the significance of a pattern is its size. Since these 1 and 2 bar patterns do not take very long to form, they are, by definition, only of short-term significance. For example, a 1-day pattern would only be expected under normal circumstances to affect the price over a 5 to 15-day period. A 2-bar pattern created from 10-minute bars would influence the trend over the course of the next 50 minutes to an hour or so. Even so, the more I study these patterns, the more impressed I become with their ability to reliably signal short-term trend reversals. Major technical principle 1 and 2 bar patterns should be interpreted as shades of gray rather than as black or white because some patterns offer stronger signs of exhaustion than others. Therefore, not all are created equal. What we are doing is hunting for clues as to the degree of exhaustion being signaled by a particular reversal phenomenon. I could say the word help, for example, but if I shout it from the rooftop, you will get the message far more clearly that I need help. The same principle operates in the marketplace. For example, if the outside bar encompasses the trading range of 3 or 4 bars, it is likely, other things being equal, to be more significant than if it barely encompasses one, and so forth. There are some ground rules to bear in mind when interpreting these formations. 1. They generally reflect an exhaustion point. In the case of an uptrend, such patterns develop when buyers have temporarily pushed prices up too far and need a rest. In the case of downtrends, there is little, if any, supply because sellers have completed their liquidation. Such formations are almost always associated with a reversal in the prevailing trend. 2. In order for these phenomena to be effective, they must have something to reverse. This means that tops should be preceded by a meaningful rally and bottoms by a sharp sell-off. 3. It is important to interpret these patterns not so much from a black and white perspective, but as shades of gray, because not all of them are created equal. Some show all of the characteristics I will be describing later in a very strong way. Others will reflect just a few characteristics in a mild way. What we might call a 5-star pattern, with all the characteristics, is more likely to result in a strong reversal than, say, a 2-star pattern that has mild characteristics. It is, therefore, necessary to apply a certain degree of common sense to their interpretation, rather than jumping to an immediate conclusion that the presence of one of these patterns guarantees a quick, profitable price reversal. 4. 1 and 2 bar formations may sometimes experience retracement moves in a similar way to classic price patterns. Since the extremities of most of these formations represent emotional support/resistance areas on the chart, retracements offer lower risk entry points. Outside bars. Outside bars are those in which the trading range totally encompasses that of the previous bar. They develop after both down and up trends and represent a strong signal of exhaustion. An example of a top reversal is shown in Figure 10.1 and a bottom in Figure 10.2. Note that example B shows what the bars would look like if they were displayed as rectangles, a smaller one followed by a longer one. Several subsequent figures reflect the same idea. There are several guidelines for deciding on the potential significance of an outside bar. They are as follows. 1. The wider the outside bar relative to the preceding ones, the stronger the signal. 2. The sharper the rally reaction preceding the outside bar, the more significant the bar. 3. The more bars encompassed, the better the signal. 4. The greater the volume accompanying the outside bar relative to previous bars, the stronger the signal. 5. The closer the price closes to the extreme point of the bar away from the direction of the previous trend, the better. For example, if the previous trend was down and the price closes very near to the high of the outside bar, this is more favorable than if it closes near the low and vice versa. Some comparative examples of strong and weak outside bars are featured in Figure 10.3. When considering outside bars, or any of the other 1 and 2 bar price patterns, it is important to ask yourself the question, what is the price action of this bar telling me about the underlying psychology? Wide bars, sharp preceding rallies or reactions, and high volume all suggest a change in the previous trend of sentiment. Chart 10.1 features the summer 2012 price action for the Dow Jones Utility ETF. In this case, the signal was a strong one because the bar was extremely wide, encompassed the trading range of 3 previous sessions, and closed near its low. Finally, the price rallied above the resistance trend line during the course of the day and closed well below it, thereby offering a classic signal of exhaustion. Also note that investors had a chance to revisit their emotions during the 2-day retracement move that took place in early August. Chart 10.2 shows a weekly outside bar for the cocoa price. This time, it's the third in a series of 3 outside bars. The effect is that they reinforce each other and produce a very strong signal. In addition, notice that the final outside bar also closes above the support/resistance trend line, joining several lows. This indicated that the downside break was a whipsaw, which added even more icing to the bullish cake. Finally, Chart 10.3 features a daily chart of the Nasdaq 100. The outside bar on the left has a lot of the ingredients of a valid pattern. It is preceded by a good rally, and the bar itself is wide and encompasses several other bars. It also opened in the direction of the then prevailing trend and closed on its low. The question naturally arises as to why it failed. One explanation is that in really strong uptrends or downtrends, 1 and 2 bar pattern reversals represent contra-trend signals, and contra-trend signals often result in whipsaws. Note that in this case, the outside bar was the market's attempt to close a gap that had opened up several trading days earlier. The lower part of the bar, therefore, reached a support area. In addition, it's important to remember that we are dealing in probabilities, not certainties in technical analysis. Failures can and do exist. That's why it is always necessary to look over your shoulder and mentally rehearse where you are going to get out, should the low probability losing scenario develop. In this case, the stop would be placed above the upper point of the outside day. The second outside bar canceled out a bearish outside bar that had formed 2 days earlier. Usually, cancellations are followed by a pretty strong move, and this example was no exception as the price rallied sharply in mid to late November. Major technical principle: not all 1 and 2 bar patterns are followed by a reversal in trend. Some, for example, may be followed by a change in trend. Inside bars. Inside bars are the opposite of outside bars in that they form totally within the trading range of the preceding bar. An outside bar indicates a strong reversal in sentiment, but an inside one reflects a balance between buyers and sellers following a sharp up or down move, which is usually later resolved by a change in trend. During the period preceding the second bar of this formation, buyers or sellers have everything going their way, depending on the direction of the trend. Then a more even balance sets in during the formation of the inside bar, which then gives way to a trend in the opposite direction. Examples of inside bars are shown in figures 10.4 and 10.5. Guidelines for determining the significance of an inside bar are as follows. 1. The sharper the trend preceding the pattern, the better. 2. The wider the first bar and its immediate predecessors in relation to previous bars, the better. This brings the strong underlying momentum of the prevailing trend to a sort of climax. 3. The smaller the inside bar relative to the outside bar, the more dramatic the change in the buyer/seller balance, and therefore, the stronger the signal. 4. Volume on the inside bar should be noticeably smaller than that of the preceding bar since it indicates a more balanced situation. Chart 10.4 shows an example of an inside bar for Rockwell Collins. It is preceded by a very wide bar, which culminates the December 2011-January 2012 rally. Normally, we would expect to see that wide bar experiencing a bigger difference between a relatively low opening and a much higher close, so the small difference between them hinted at a change in balance between buyers and sellers. That was confirmed by the inside bar, for which volume and volatility were much reduced. Note also the two small outside bars that signaled the start and end of a small December rally. Chart 10.5 shows many technical events, including an inside bar just prior to the start of a major rally. Sometimes these characteristics develop at a time when longer-term forces are poised for a major upthrust, and that was obviously the case here, because there was no way to tell from the inside bar itself that such a robust advance would follow. Note also that the ranging action that preceded the inside bar was influenced by two outside bars at A and B. Remember, these patterns are expected to have an effect for only 5 to 10 bars, so these, which triggered 3-day rallies, came up a little short. Finally, the bearish outside bar that developed in early March 2012 possessed very strong characteristics. First, it whipsawed above the trend line, joining the two previous highs. Second, it encompassed many previous days of trading, and third, it closed near to its low. Two-bar reversal. A two-bar reversal is a classic way in which the charts signal exhaustion. These patterns develop after a prolonged advance or decline. Examples are shown in figures 10.6 to 10.8. The first bar of the formation develops strongly in the direction of the then prevailing trend. For a 5-star signal in an uptrend, we need to see the close of the bar at, or very close to, its high. At the opening of the next period, buyers come in expecting more of the same. This means the price should open very close to the high of the previous bar. However, the whole point of the two-bar reversal is that a change in psychology takes place as the bar closes slightly above or slightly below the low of the previous bar. Hence, the high expectations of participants at the opening of the bar are totally dashed at the end of the period, indicating a change in trend. To be effective, this has to be a climactic experience. This means that the two-bar reversal should contain as many of the following elements as possible. 1. It needs to be preceded by a persistent trend. 2. Both bars should stand out as having exceptionally wide trading ranges relative to previous bars. 3. The opening and closing of both bars should be close to their extremities. 4. An expansion of volume on both bars enhances the concept of a change in sentiment. 5. Heavier volume on the second bar relative to the first emphasizes the preponderance of traders acting in the direction of the new trend. 6. Since a two-bar reversal ideally should indicate an abrupt change in sentiment, ideally they should not be followed by much in the way of a retracement move. Chart 10.6 features a 5-minute bar for the S&P composite, where we see a classic pattern, with the highs and lows falling at exactly the correct points following a good rally. Note also that the second bar slightly exceeds the trading range of the first. This outside bar element adds a bearish factor to the pattern. Chart 10.7 shows a two-bar reversal at the climax of a rally in U.S. Bancorp in the fall of 2000. Note how the volume expands dramatically. Also, volume on the second day was slightly higher than that on the first, thereby providing an additional clue that the tide had turned in favor of the sellers. Finally, Chart 10.8, featuring FX Energy, shows how two-bar reversals sometimes form as whipsaws, where the closing of the initial bar and the opening of the second one temporarily move through a support or resistance level. In Chart 10.8, this happens to be resistance, as all those who went long during the formation of the two-bar reversal are trapped below the resistance trend line. This kind of situation is typically followed by an above-average decline and vice versa with a downside whipsaw. These 1 and 2 bar price patterns generally have an effect for a very short period of time. They are not, therefore, suitable for long-term investors. However, for traders who are looking for clear-cut entry and exit points, they can be of immense value. Key reversal bars. A key reversal bar is one that develops after a prolonged rally or reaction. Often, the trend will be accelerating by the time the price experiences the key reversal bar. The classic pattern has the following characteristics. 1. The price opens strongly in the direction of the prevailing trend. 2. The trading range is very wide relative to the preceding bars. 3. The price closes near or below the previous close, or near or above the previous close in a downtrend reversal. 4. Volume, if available, should be climactic on the key reversal bar. Examples of key reversal bars are featured in figures 10.9, 10.10, and 10.11. In many cases, a retracement move follows a key reversal bar, especially if the initial reversal in trend is unduly sharp. Normally, the extreme point of the reversal bar is not exceeded. Chart 10.9 shows a classic example in the left part of the chart, as the short-term rally is climaxed by an explosion of volume and a wide key reversal bar. Quite often, a key reversal is followed by a sharp change in trend and a subsequent retracement. That is exactly what happened in this case as the price rallied in the fourth and fifth session following the key reversal. Note that the termination of this brief advance was signaled by an outside bar. The second example of a key reversal to the right is also a good one, in that volume expands along with the trading range. However, it is not preceded by much of a rally and would not, therefore, earn as many stars as the first one. Exhaustion bars develop after a really sharp up or down move. They are a form of key reversal but differ sufficiently enough to warrant their own category. The requirements for an exhaustion bar are as follows. 1. The price opens with a large gap in the direction of the then prevailing trend. 2. The bar is extremely wide relative to previous bars. 3. The opening price develops in the lower half of the bar in a downtrend and in the upper half in an uptrend. 4. The closing price should be both above the opening and in the top half of the bar in a downtrend, and in the lower half and below the opening in an uptrend. 5. The bar is completed with a gap to the left still in place. Examples of exhaustion bars for both the top and bottom are featured in figures 10.12 and 10.13. They differ from the one-bar island reversal, in that, while there is a gap to the left of it, there is no gap between the exhaustion bar and its successor. Examples of one-bar island reversals are shown in figure 10.14. What we are looking for here is an extreme movement in the price that is preceded by an already strong move. The idea is that a bullish bar following a sharp decline opens with a huge gap, but closes above the opening and, ideally, more than halfway up the trading range. This reflects the concept of a reversal in psychology. The large gap and wide trading range also point up the kind of frenzied activity associated with a turn. The opposite set of conditions would be present for a bearish exhaustion bar. Chart 10.10, featuring the 2012 price action of Ruby Tuesday, shows a classic exhaustion bar with the price gapping down sharply following a waterfall decline. Then it closes well into the upper half of the bar, indicating that the sellers were no longer in control. The huge volume also contributed to the idea that an important change in sentiment had taken place. You will find that gaps almost always develop on the intraday charts at the open due to some overnight change in psychology. This means that exhaustion bars tend to be more prevalent in these very short-term charts. Pinocchio bars. Exhaustion also shows itself in forms that are different from those we have so far considered. I call these Pinocchio bars because they temporarily give us a false sense of what is really going on. They are bars in which the bulk of the trading takes place beyond a support or resistance zone, but the open and close do not. Often, this means the false move takes the price beyond a previous trading range, thereby giving a false impression of a breakout. The character Pinocchio tells us when he is lying because his nose gets bigger. In the case of our Pinocchio bar, it is the isolated part of the bar above the open and close, or below them for a bullish bar, that is the big nose that by the end of the bar signals a probable false move. Figures 10.15 and 10.16 offer two examples of false upside Pinocchio breaks. Figure 10.16 indicates that when a false break develops above a downtrend line, this is indicative of exhaustion since the price cannot hold above the strong resistance reflected by the trend line. Marketplace examples of Pinocchio bars are featured in charts 10.11 and 10.12. The first shows a break above the trading range, which was nullified by the time the bar closed. The second shows a false break to the downside. As so often happens following whipsaws, the price moved in the opposite direction from that indicated by the break. The outside bar in the left part of chart 10.12 offers another form of Pinocchio bar. One important fact about an exhaustion move is that the extremity of the move often proves to be an important support or resistance point. In that respect, it is often a good idea to place a stop loss a little bit beyond the extremity of the Pinocchio bar, provided, of course, that still results in a reasonable risk-reward. Summary. 1. 1 and 2 bar reversals reflect exhaustion and usually signal a reversal in trend. 2. To be effective, these reversals must be preceded by a worthwhile move. 3. Their trend reversal significance is only of short-term duration. What constitutes as short-term will depend on the time span of the bar or bars in question. 4. Daily or weekly reversal patterns will be far more significant than those appearing on intraday chart. 5. Reversal bars that contain more of the required characteristics normally provide stronger signals than those that only have a few. Chapter 11. Moving Averages. It is evident that trends in prices for any freely traded entity can be very volatile, almost haphazard at times. One technique for dealing with this phenomenon is the moving average MA. An MA attempts to tone down the fluctuations of stock prices into a smooth trend so that distortions are reduced to a minimum. The three principal types of MAs used in technical analysis are simple, weighted, and exponential. When the terms moving average or MAs are used in this book, we are referring to the simple type. Exponential MAs, EMA, and weighted MAs, WMA, will always be specifically referenced. The construction and use of these averages are different. Therefore, each type will be dealt with in turn. In the meantime, it's important to remember that MAs, like trend lines, should be considered as dynamic levels of support and resistance. They are dynamic because, unlike specific levels which by definition remain constant, MAs keep changing their values. If a specific MA has not worked well in the past on a particular security, there are few grounds for suspecting that it will in the future and vice versa. Simple MA. A simple MA SMA is by far the most widely used. It is constructed by totaling a set of data and dividing the sum by the number of observations. The resulting number is known as the average or mean average. In order to get the average to move, a new item of data is added and the first subtracted. The new total is then divided by the number of observations, and the process is repeated. For example, the calculation of a 10-week MA would follow the method shown in Table 11.1. On March 12, the total of the 10 weeks ending on that date was 966, and 966 divided by 10 results in an average of 96.6. On March 19, the number 90 is added and the observation of 101 on January 8 is deleted. The new total of 955 is then divided by 10. The calculation of a 13-week MA would require totaling 13 weeks of data and dividing by 13. This process is then repeated in order to get the average to move. Generally speaking, a rising MA indicates a rising trend market strength, and a declining one denotes weakness. A comparison of the price index with its 13-week MA chart 11.1 shows that the average changes direction well after the peak or trough in the price and is, therefore, late in changing direction. This is because the MA is plotted on the 13th week, whereas the average price of 13 weeks of observations actually occurs halfway through the week time span, i.e., in the 7th week. If it is to reflect the underlying trend correctly, the latest MA should be centered, i.e., plotted on the 7th week, as shown in chart 11.1 for the Nasdaq 100. The chart in the lower panel shows an MA that has been centered. The good news is that it turns fairly closely to the turning point in the price. The bad news is that it is necessary to wait 6 weeks before it's possible to ascertain whether the average has changed direction. See how the centered MA plot ends 6 weeks prior to the end of the chart. A time delay, though it is an irritant, is not particularly critical when analyzing other time series such as economic data. However, given the relatively rapid movement of prices in the financial markets and consequent loss of profit potential, a delay of this nature is totally unacceptable. Technicians have found that, for the purpose of identifying trend reversals, the best results are achieved by plotting the MA on the final week. Changes in the price trend are identified, not by a reversal in direction of the MA, but by the price itself crossing its MA. A change from a rising to a declining market is signaled when the price moves below its MA. A bullish signal is triggered when the price rallies above the average. Since the use of MAs gives clear-cut buy and sell signals, it helps to eliminate some of the subjectivity associated with the construction and interpretation of trend lines. More often than not, it pays to take action based on MA crossovers, but only if you can look back and see a fairly consistent relationship between the price and the MA. The degree of accuracy depends substantially on the choice of MA, as discussed later. First, we need to examine some of the characteristics of MAs in greater detail. Moving average characteristics. 1. An MA is a smoothed version of a trend, and the average itself is an area of dynamic support and resistance. In a rising market, price reactions are often reversed as they find support in the area of the MA. If the rest of the evidence agrees, it's not a bad idea to wait for the price to reach its MA prior to making a purchase. After all, if the MA represents support, you can place a stop below support, i.e., the MA. Similarly, a rally in a declining market often meets resistance at an MA and turns down. The more times an MA has been touched, i.e., acts as a support or resistance area, the greater the significance when it is violated. 2. A carefully chosen MA should reflect the underlying trend. Its violation, therefore, warns that a change in trend may already have taken place. If the MA is flat or has already changed direction, its violation is fairly conclusive proof that the previous trend has reversed. 3. If the violation occurs while the MA is still proceeding in the direction of the prevailing trend, this development should be treated as a preliminary warning that a trend reversal has taken place. Confirmation should await a flattening or a change in direction in the MA itself, or should be sought from alternative technical sources. 4. Generally speaking, the longer the time span covered by an MA, the greater is the significance of a crossover signal. For instance, the violation of an 18-month MA is substantially more important than a crossover of a 30-day MA. 5. Reversals in the direction of an MA are usually more reliable than a crossover. In instances in which a change in direction occurs close to a market turning point, a very powerful and reliable signal is given. However, in most instances, an average reverses well after a new trend has begun, and so is only useful as a confirmation. In short, think of an average as a type of moving trend line, which, like an actual trend line, obtains its significance from its length time span, the number of times it has been touched or approached, and its angle of ascent or descent. What is a valid crossover? A crossover is any penetration of an MA. However, close observation of any chart featuring an MA will usually reveal a number of whipsaw or false signals. How can we tell which ones are going to be valid? Unfortunately, there is no way of knowing for certain. Indeed, many whipsaws cannot be avoided and should be regarded as a fact of life. However, it is possible to avoid some of these close calls by using filtering techniques. The type of filter to be used depends on the time span in question and is very much a matter of individual experimentation. For example, we may decide to take action on MA crossovers for which a 3% penetration takes place and to ignore all others. Violations of a 40-week MA might result in an average price move of 15 to 20%. In this instance, a 3% penetration would be a reasonable filter. On the other hand, since 3% would probably encompass the whole move signaled by a 10-hour MA crossover, this kind of filter would be of no use whatsoever. Some analysts, recognizing that one-period whipsaws are quite common, require an MA crossover to hold for at least 2 periods. In the case of daily data, this approach would mean waiting for the second or third day before concluding that the average had been violated. A more sensible method is to use a combination of the period and percentage penetration for deciding whether a crossover is valid. A useful tip is to wait for an MA crossover to take place at the same time a trend line is violated or a price pattern completed. Such signals strongly reinforce the trend line or price pattern signal, and therefore need less in the form of a filter requirement. 2 examples are shown in Chart 11.2 for the iShares MSCI Brazil ETF. Sometimes, it's possible to see an MA crossover accompanied with exceptionally heavy volume. In such circumstances, you could lower your standards of what represented a decisive breakout, since the expanding volume would emphasize enthusiasm by the buyers or fear by the sellers, depending on the direction of the break. We see this in Chart 11.3 for an early August 2012 downside break in the iShares MSCI Emerging Markets ETF. The cross was accompanied by expanding volume and a trendline break. 2 other breaks also developed on expanding activity, one of which was an upside violation, which was also associated with a trendline break. Chart 11.4 features the Euro Top Index together with a 40-week MA and 2 bands that have been plotted 3% above and below the average itself. Buy signals are generated when the price crosses above the upper line and sell signals when it crosses below the lower one. This has the effect of filtering out some of the whipsaws, yet does not give up too much in terms of timing. MAs are usually constructed from closing data. These are more reliable than intra-session prices because they reflect positions that investors are willing to carry overnight or, in the case of weekly charts, over the weekend. Moreover, bar charts are subject to intraday rumors and other random noise. It's certainly true that the bar charts are penetrated intraday and therefore offer more timely signals. However, there are also a far greater number of whipsaws or misleading signals. That's because the intraday trading can be subject to manipulation or distorted by knee-jerk emotional reactions to news events. For this reason, it is usually best to wait for the closing price to penetrate the average before concluding that a crossover has taken place. One exception to using close-only charts would be if the MA was touched or approached by the highs or lows of the bars on numerous occasions. In this instance, it would mean that the MA represented an unusually strong resistance or support level. Consequently, its penetration would have greater significance. During a trading range, MA crossovers have a strong tendency to be counterproductive. 2 examples are shown in Chart 11.5 for Asian paints, an Indian stock. In these situations, it is usually best to use the outer ends of the trading range for the signal rather than the MA. Obviously, no one rings a bell to say the price has entered a trading range, but after a couple of whipsaw signals, it becomes apparent. That is the time when a well-constructed trend line should be substituted for an MA crossover. Choice of time span. MAs can be constructed for any time period, whether a few days, several weeks, many months, or even years. Optimal selection of length is very important. For example, if it is assumed that a complete bull and bear cycle lasts for 4 years, an MA constructed over a time span longer than 48 months will not reflect the cycle at all. This is because it smooths out all the fluctuations that take place during the period and will appear more or less as a straight line crossing through the middle of the data, unless there is a particularly sharp linear trend. On the other hand, a 5-day MA will catch every minor move in the stock cycle and will be useless for the purpose of identifying the actual top and bottom of the overall cycle. Even if the 48-month average were shortened to 24 months, using the crossover signals would still cause the 24-month average to give an agonizingly slow confirmation of a change in trend. The 4-week average would be so sensitive that it would continually give misleading or whipsaw signals. Only an MA that can catch the movement of the actual cycle will provide the optimum trade-off between lateness and oversensitivity, such as the 10-month MA in Figure 11.1. The choice of MA depends on the type of market trend that is to be identified, i.e., short, intermediate, or primary. Because different markets have different characteristics and the same markets go through different cyclic phenomena, there is no such thing as a perfect MA. In recent years, extensive computer research has been done on the optimum MA time span. The conclusion from all sources is that there is no one perfect time span. What may work extremely well in one market over one specific period of time is unlikely to be duplicated in the future. When we talk about choice of time span, we are really trying to identify an MA that will work most of the time with a specific time frame, i.e., short, intermediate, or long. Perfection just does not exist in psychologically driven markets. Generally speaking, long-term time spans are less influenced by manipulation and knee-jerk random reactions to unexpected news than are short-term ones. This is why long time spans usually give the best test results. Both daily and weekly averages work best at or above a 40-period span. Research also shows that simple averages generally outperform weighted and exponential ones. Recognizing these limitations, the time spans in Table 11.2 are suggested. The important thing to remember is that an MA is one tool in the technical arsenal, which is used with other techniques as part of the art of identifying trend reversals. Again, it's important to remember that we are looking for a time span that works reasonably well over most securities, i.e., the idea of consistency over perfection. After all, it's always possible to find the perfect time span with backtesting and fitting the data accordingly. However, we are interested in the past only insofar that it can reliably point us in the right direction in the future, and deliberately fixing past results does not help us in this task. Quite the reverse. Advancing a simple moving average, a technique that has a lot of potential but is not widely used, is to advance an MA. In the case of a 25-day MA, for example, the actual plot would not be made on the 25th day, but advanced to the 28th or 30th, and so forth. The advantage of this approach is that it delays the crossover and filters out occasional whipsaws or false signals. In Profits in the Stock Market, Lambert Gann Publishing, 1935, H.M. Gartley calculated that, during the period 1919-1933, which covered almost all kinds of market situations, use of a simple 25-day MA crossover netted 446 Dow points, slightly better than 433 points for the 30-day MA, and far better than 316 and 216 for 40 and 15-day MAs, respectively. However, when the 25-day average was plotted on the 28th day, crossovers resulted in an increase of 231 points to 677. The 30-day MA, when advanced 3 days, also produced superior results, with an additional gain of 204 points for a total of 637. Although the 25-day MA advanced 3 days may not ultimately prove to be the best combination, the technique of advancing an MA is clearly one that could be usefully incorporated into the technical approach. It is always difficult to know how much to advance an MA. Experimentation is the answer. One possibility is to advance the average by the square root of the time span, e.g., a 36-week MA would be advanced by 6 days. The square root of 36 equals 6. In that spirit, Chart 11.6 features the iShares MSCI Hong Kong ETF with both a 25-day MA and a 25-day MA that has been advanced by 5 days. Note how the regular dashed MA experiences whipsaws as flagged by the solid arrows, whereas the advanced solid MA does not. The dashed arrows indicate where both MAs are penetrated on a whipsaw basis. This approach appears to come into its own after a strong trend, such as when the regular average was temporarily penetrated by 2 small back rallies that developed in November 2008. It is in situations such as this that the delaying effect of advancing the MA avoids the whipsaw. Of course, there is a trade-off, and that comes in the form of delayed signals, but in most situations, the loss of timing is offset by fewer misleading signals. Convergence of averages. A sharp price move is often preceded by a gradually narrowing trading range. In effect, decreasing price fluctuations reflect a very fine balance between buyers and sellers. When the balance is tipped one way or the other, the price is then free to embark upon a major move. This kind of situation can often be identified by plotting several MAs and observing when they are all at approximately the same point. Chart 11.7, for example, shows the daily price for cash euro-yen. Note how the 3 MAs almost completely converge just before the price embarks on a sharp decline. The convergence of the averages warns that a major move is likely, but the actual signal comes from the violation of the trend line. Multiple simple mass. Some techniques of trend determination involve more than one MA. Signals are given by a shorter-term MA crossing above or below a longer one. This procedure has the advantage of smoothing the data twice, which reduces the possibility of a whipsaw, yet it warns of trend changes fairly quickly after they have taken place. In this respect, Chart 11.8 features the iShares MSCI Italian ETF. 2 averages that have traditionally been used for identifying primary trend moves are the 10 and 30-week spans. Signals are given when the dashed 10-week average moves below the 30-week average. Some technicians prefer to wait until the 30-week series is moving in the direction of the cross, so a negative cross would require a declining 30-week MA. Negative signals of either variety warn that the major trend is down. It is not assumed to have reversed until either the 10-week MA moves higher than the 30-week MA, or it does so when both are rising simultaneously. By definition, either methodology results in signals being triggered after the ultimate price peak or trough. Therefore, they serve as a confirmation of a change in trend rather than as actual juncture points in themselves. If the signal develops close to the final turning point, then it can be acted upon in a timely and practical way. On the other hand, if it is triggered some distance from the previous peak or trough, then it can merely be used as confirmation. Even that information can be useful because if you are going to run into trouble, it will usually be when you act on a contra-trend signal. A clearer understanding of the direction of the main trend through this double moving average approach will offer less of a chance that contra-trend trades will be executed. An alternative approach is to use 2 averages of similar or identical time spans and advance the plot of one of them along the lines discussed earlier. Chart 11.9, which again features the Italian ETF, shows such a setup for a 25-week MA and a 25-week MA advanced by 5 weeks. The advantage of this method is that it appears to generate fewer whipsaws. The disadvantage is that the signals have a tendency to be less timely. These 2 multiple moving averages are not offered as the holy grail, but more as a starting point because I am sure that the resourceful reader could come up with a better combination. Just remember in such experimentation that consistency is much preferred over perfection, which does not exist, of course. MAs should always be used in conjunction with other indicators. This is because prices occasionally fluctuate in a broad sideways pattern for an extended period of time, resulting in a series of misleading signals. The good news is that such frustrating trading range action is often followed by an extremely strong trend in which the losses incurred from the trendless period of whipsaw signals are more than made up for. This is because the whipsaws indicate confusion between buyers and sellers, and this implies a big battle. When one or the other wins out, the victorious side is then able to push prices in a much stronger way. Figure 11.2 shows an example of an MA offering numerous whipsaw signals as it moves through a trading range. At first, it is not obvious that the price action is a trading range. However, at point X, when the price crosses below the MA again, it is possible to construct two trend lines that reflect this ranging action. At such a time, it makes much better sense to await the verdict by acting on a trendline break rather than an MA crossover, since there is no reason to suspect that the next crossover after X will not turn out to be a whipsaw. Weighted mass. A simple moving average SMA can only correctly represent a trend from a statistical point of view if it is centered, but centering an average delays the signal, as discussed earlier. One technique that attempts to overcome this problem is to weight the data in favor of the most recent observations. An MA constructed in this manner, WMA, is able to turn or reverse direction much more quickly than a simple MA, which is calculated by treating all the data equally. There are countless ways in which data can be weighted, but the most widely used method is a technique whereby the first period of data is multiplied by 1, the second by 2, the third by 3, and so on until the most recent one. The calculations for each period are then totaled. The divisor for a simple MA is the number of periods, but for this form of weighted average, the divisor is the sum of the weights, i.e., 1 plus 2 plus 3 plus 4 plus 5 plus 6 equals 21. For a 10-week weighted MA, the sum of the weights would be 1 plus 2 plus 3 plus 4 plus 5 plus 6 plus 7 plus 8 plus 9 plus 10 equals 55. Table 11.3 illustrates how the calculations are made. Another method is to calculate a simple MA, but in doing so, use the most recent observation twice, which doubles its weight. The interpretation of a weighted average is different from that of a simple average because the weighted average is more sensitive. A warning of a trend reversal is given by a change in direction of the average rather than by a crossover. Exponential moving averages. Weighted MAs are helpful for the purpose of identifying trend reversals. In the past, the time-consuming calculations required to construct and maintain such averages greatly detracted from their usefulness. The widespread use of computers in the last few decades has largely overcome this drawback. An exponential moving average, EMA, is a shortcut to obtaining a form of weighted MA. A calculation for a 20-week EMA is shown in Table A circumflex Euros 11.4. In order to construct a 20-week EMA, it is necessary to calculate a simple 20-week MA first, i.e., the total of 20 weeks of observations divided by 20. In Table 11.4, this has been done for the 20 weeks ending January 1, and the result appears as 99.00 in column 6. The 20-week average becomes the starting point for the EMA. It is transferred to column 2 for the following week. Next, the entry for the 21st week, January 8 in the earlier example, is compared with the EMA, and the difference is added or subtracted and posted in column 3, i.e., 100 minus 99 equals 1.00. This difference is then multiplied by the exponent, which for a 20-week EMA is 0.1. This exponentially treated difference, 1.00 times 0.1, is then added to the previous week's EMA, and the calculation is repeated each succeeding week. In the example, the exponentially treated difference for January 8 is 0.1, which is added to the previous week's average, 99.00, to obtain an EMA for January 8 of 99.10. This figure in column 6 is then plotted. If the difference between the new weekly observation and the previous week's EMA is negative, as in the reading 99.00 versus 99.64 for January 29, the exponentially treated difference is subtracted from the previous week's EMA. The exponent used varies with the time span of the MA. The correct exponents for various time spans are shown in Table 11.5, where the time periods have been described as weekly. In effect, however, the exponent 0.1 can be used for any measure of 20 days, weeks, months, years, or an even longer period. Exponents for time periods other than those shown in the table can easily be calculated by dividing 2 by the time span. For example, a 5-week average will need to be twice as sensitive as a 10-week average. Thus, 2 divided by 5 gives an exponent of 0.4. On the other hand, since a 20-week average should be half as sensitive as for a 10-week period, 0.2, its exponent is halved to 0.1. If an EMA proves to be too sensitive for the trend being monitored, one solution is to extend its time period. Another is to smooth the EMA by another EMA. This method uses an EMA, as calculated earlier, and repeats the process using a further exponent. There is no reason why a third or fourth smoothing could not be tried, but the resulting EMA, while smoother, would be far less sensitive. By definition, EMA crossovers and reversals occur simultaneously. Buy and sell signals are, therefore, triggered by crossovers just like a simple moving average. Types of MA compared. Chart 11.10 shows the 3 types of calculations plotted on the same chart of the popular Indian market index, the Nifty. You can see that at essentially all times the weighted WMA average is the most sensitive since it hugs the turning points more closely. The simple SMA and exponential EMA alternate, depending on how the data falls. My experience is that in most situations the SMA works best, though I have to admit that, unless I am relying on a longer-term time span, such as a 200-day/9-month average, I rarely place much emphasis on the crossovers unless other evidence, such as a trendline break, suggests that the trend has reversed. Useful MA time spans. Table 11.2 has already listed some suggested time frames for simple moving averages. This section will expand the discussion a bit by applying some of these ideas to the markets. We discuss the importance of the primary trend and the need to identify its direction earlier. That brings us to the subject of the 12-month SMA. This time span has been very useful for identifying reversals in such trends, as has the 9-month, 200-day/39-week one. It really does not matter too much which you choose, although the 12-month span is preferred since it contains all the months of the calendar year and is therefore seasonally adjusted. Chart 11.11 shows the Morgan Stanley Capital International MSCI World Stock Index. If you are going to monitor primary trends, a 12-month MA for this global equity series is not a bad place to start. The solid arrows indicate where the 12-month MA has acted as a good support/resistance zone. The dashed ones show a couple of whipsaw signals, which emphasize the point that we are going for consistency over perfection. Most of the period under consideration experienced primary bull markets, but the shaded areas indicate primary bears, as defined by the relationship between the index and its MA. Chart 11.12 features a 200-day SMA for the dollar-based gold price. Once again, it gets its share of whipsaw signals, but by and large, it works reasonably well. It further underlies the point that MA crossovers should not be used in isolation, but in conjunction with other indicators to form a weight of the evidence approach. Finally, Chart 11.13 shows a 65-week EMA for the Canadian dollar/US dollar cross. This time span appears to be very useful for incorporation with longer-term charts. The solid arrows note the places where the average serves as an effective support/resistance zone, whereas the dashed ones point up some whipsaws. You should not expect all markets to behave this well, but if it's possible to look back at several years of data and see such a good relationship, then it's reasonable to expect it to work reasonably well in the future. If not, then lower the importance of the average in your analysis. You may be wondering why we have not included many short-term MAs in our explanation. The reason is that the briefer the time frame under consideration, the greater the effect of random noise and the less reliable the MA crossover technique becomes. Summary 1. One of the basic assumptions of technical analysis is that stocks move in trends. Since major trends comprise many minor fluctuations in prices, an MA is constructed to help smooth out the data so that the underlying trend will be more clearly visible. 2. Ideally, a simple MA SMA should be plotted at the halfway point of the time period being monitored, a process known as centering. But since this would involve a time lag during which stock prices could change rapidly and lose much of the potential profit of a move, it is plotted at the end of the period in question. 3. This drawback has been largely overcome by the use of MA crossovers, which provide warnings of a reversal in trend, and by the use of WMAs or EMAs, which are more sensitive to changes in the prevailing trend since they weight data in favor of the most recent periods. 4. There is no such thing as a perfect average. The choice of time span always represents a trade-off between timeliness, catching the trend at an early stage, and sensitivity, catching the trend turn too early and causing an undue amount of whipsaws. For short-term trends, 30 and 50-day spans are suggested, but for longer-term time spans, 40 and 45-week averages are recommended. A helpful time span using monthly data is 12 months. Chapter 12. Envelopes and Bollinger Bands. Envelopes. It has already been established that moving averages MA can act as important juncture points in their role as support and resistance areas. In this respect, the longer the time span, the greater the significance of MAs. This support and resistance principle can be taken one step further by constructing symmetrical lines parallel to an MA of any variety, called envelopes, see Figure 12.1. This technique is based on the principle that stock prices fluctuate around a given trend in cyclical movements of reasonably similar proportion. In other words, just as the MA serves as an important juncture point, so do certain lines drawn parallel to that MA. Looked at in this way, the MA is really the center of the trend, and the envelope consists of the points of maximum and minimum divergence from it. Just as a leash pulls an unruly dog back to its owner and then allows him to run off in the opposite direction until the leash stops him, prices act in a similar manner. The leash in this case is the two envelopes, or more if we choose to draw them. There is no hard and fast rule about the exact position at which the envelope should be constructed. That can be discovered only on a trial and error basis with regard to the volatility of the price being monitored and the time span of the MA. This process can be expanded, as in Figure 12.2, to include 4 or more envelopes, i.e., 2 above and 2 below the MA. Each is drawn at an identical proportional distance from its predecessor. In this example, the envelopes have been plotted at 10% intervals. If the MA is at 100, for example, the envelopes should be plotted at 90, 110, etc. Since prices are determined by psychology, and psychology tends to move in proportion, for example, 10% above and below the MA as opposed to 10 points, etc. Chart 12.1, which features the Indian market average, the Nifty, shows that the envelope technique can be helpful from 2 aspects. 1, developing a feel for the overall trend, and 2, discerning when a rally or reaction is overextended. The disadvantage is that there is no certainty that the envelope will prove to be the eventual turning point. This method, like all techniques that attempt to forecast the duration of a move, should be used on the basis that if the index reaches a particular envelope, there is a good probability that it will reverse course at that juncture, provided, of course, that the envelope has had a reasonable record of acting as a support/resistance point in the past. The actual trading or investment decision should be determined after assessing a number of characteristics, of which envelope analysis is one ingredient. In Chart 12.1, you can see that the upper band consistently acted as a good resistance zone during the 2004-2008 bull market. However, the advance in 2009 was so strong that reaching the upper envelope really had no technical meaning whatsoever. As for the downside, there were a couple of times the price reversed at the 10% level, but either it never reached it, as in the 2004-2006 period, or it greatly exceeded it, as in 2008. Clearly, If this technique is to be employed with any degree of certainty, it is very important to make a careful study of the relationship between the price and a specific envelope ahead of time to establish its reliability. In this respect, Chart 12.2 shows the iShares Biotech ETF with a 10% envelope. The lower panel shows the data displayed in a different manner, with the MA at 0 and the upper and lower envelopes being represented by the dashed horizontal lines at plus 10% and 10%. Note how the envelopes often serve as support and resistance areas, and that the price occasionally swings from one envelope to the other, just as the oscillator swings like a pendulum from an overbought to oversold condition. Chart 12.3 goes through a similar exercise for the Brazilian Bovespa index, but this time, the envelope has been expanded to 35% to suit the characteristic of the market. Once again, the touching of the envelope suggests the direction of the primary trend. Upper envelope touches being a bull market characteristic and vice versa. That does not mean that touching the outer band is a prerequisite for a bull market. Just as it's possible to have winter without snow, it's also possible to experience a primary trend where the outer envelope is not touched or penetrated. The dashed arrows show that the recrossing of the envelope is usually followed by an important decline of some kind. The early 2004 signal was an obvious exception to this rule. My suggestion is to experiment with many different combinations of MAs and envelopes because each security has its own personal characteristics. Some will work quite well for you, but never expect perfection. It doesn't exist. Bollinger Bands the concept. Bollinger Bands Chart 12.4 operate in a similar way, except that the envelopes or bands are calculated using standard deviations. 1 for those of you who, like me, are not mathematically oriented. A simple explanation is that the bands contract or expand, depending on the level of volatility. The greater the volatility, the wider the bands and vice versa. The first requirement in plotting a Bollinger Band is a time span, as with a moving average. The longer the span, the smoother but less sensitive are the fluctuations. Chart 12.4, featuring the Nasdaq 100 ETF, plots both bands with the standard or default time span of 20 periods and a deviation of 2. Chart 12.5 compares the difference with different smoothings. The plot in the upper window shows one of 10 days, and the lower one a smoothing of 40 days. It is pretty obvious that the 40-bar span is far smoother and is plotted further away from the price action. The second parameter for plotting a Bollinger Band is the amount of deviation. In this respect, the bands in the upper window of Chart A circumflex Euros 12.6, again featuring the Nasdaq 100 ETF, are calculated with a value of 4. The lower panel takes it to the other extreme with a deviation of 1%. It is fairly evident from this comparison that the smaller the deviation, the tighter the band and vice versa. The tight band in the lower panel is touched so many times, it is not at all useful. Alternatively, a larger deviation factor returns a band that is rarely, if ever, touched. Think of the deviation as a parameter that corresponds with an overbought/oversold level. John Bollinger, the creator of this technique, recommends a factor of 20 for the time span and 2 for the deviation. Those are the parameters used for the remainder of charts in this chapter. Rules for interpretation. Rule 1. When the bands narrow, there is a tendency for sharp price changes to follow. This, of course, is another way of saying that when prices trade in a narrow range and lose volatility, demand and supply are in a fine state of balance and its resolution will trigger a sharp price move. In this context, a narrowing of the bands is always relative to the recent past. That's where Bollinger Bands can help visually by showing the narrowing process. They also give us some indication of when a breakout might materialize, because the bands start to diverge once the price begins to take off. 2 examples are shown in Chart 12.7, where it is also possible to construct some trend lines marking the breakout points. Rule 2. If the price exceeds a band, the trend is expected to continue. This is really another way of saying that if the price moves above the band, upside momentum is strong enough to support higher ultimate prices, and vice versa. This is a common experience at the start of a bull market and vice versa for a downward penetration. After both breakouts in chart 12.7, we see the price immediately move outside the band. The recrossover of the Bollinger Band usually indicates short-term exhaustion, and it quickly pulls back again. However, this is just a process of pausing for breath until the trend is then able to extend again. By now, you will have noticed that the price often crosses the band several times before the trend reverses. The obvious question at this point is, how do you know when it has been crossed for the last time? In other words, how do you know how to spot the bottom and top of a move? The answer lies in the next rule. Rule 3. When the price traces out a reversal formation after it has crossed outside a band, expect a trend reversal. In chart 12.8, featuring the New York Stock Exchange NYSE composite, we see a series of 3 rallies that touch or exceed the upper band range A. The first 2 show no sign of exhaustion. However, after the final attempt, the uptrend line is violated. Then the price falls below the previous minor low to complete a small top at point F. Later, the price touches the outer band again just prior to the trading range at B, but there is no signal since it manages to hold above the lower portion of the trading range. Finally, a nice uptrend line is violated and a sell signal is triggered at point E, following a temporary penetration of the outer band. What we are seeing is a series of overstretched readings, which is what a price touching the band really is. It finally confirms the overbought reading. If there is no signal, the implication is that following a brief correction, the price will then go on to register a new high or low for the move, depending on its direction. That is not always the case because there is no such word as always when working with technical indicators. For instance, chart 12.9, also featuring the NYSE composite, shows where the price crosses below the upper band point A, yet it does not go on to make a new high until a worthwhile decline has taken place. In such instances, the best place to liquidate a long position is when the price crosses below the moving average. Later on, at point B, you can see a small double top as the price tries for a second time to break above the band. At the next attempt, point C, there is no signal, but after the subsequent penetration, a trend line is violated point D. Then we see a series of lows range E, but this support was not broken, so there was no reason to sell. Finally, the price tries to break out from the trading range, but is held back by the upper band point F. A subsequent trendline break, point G, is the signal to liquidate. In retrospect, what we see is a failed breakout, which just adds to the bearishness once the series of lows is penetrated on the downside. Sometimes it is possible to combine Bollinger Band analysis with the no sure thing, KSD. This indicator is discussed at length in Chapter 15. For now, just think of it as a smoothed momentum indicator that triggers buy and sell momentum indications when it crosses above or below its moving average. In chart 12.10 featuring Vijaya Bank, an Indian stock, the bands narrow in the late October period as the price experiences a sideways correction. The question is, which way will the price break? A vital clue can sometimes be gleaned by looking at an oscillator. In this chart, I am using the KSD, but it could easily be the moving average convergence divergence MACD, stochastic, relative strength indicator, RSI, and so forth. The idea is that the KSD is already declining and therefore telling us that short-term momentum is trending down. Since the price soon confirms the violation of the dash trend line, it is not surprising that the narrowing bands, i.e., finely balanced supply/demand situations, are resolved in a negative way. Later on at point B, we see a similar setup with the narrowing bands. This time, the KSD falls below its MA at around the same time that the trend line is violated. Summary. 1. Envelopes are moving averages that are plotted at equidistant levels above and below a specific moving average. 2. They provide useful support/resistance points that often halt rallies and reactions. 3. Occasionally, it is a good idea to plot several series of envelopes around the moving average. 4. Bollinger Bands are a form of envelope that is constructed from standard deviations. These expand and narrow depending on pricing volatility. 5. When Bollinger Bands narrow, the subsequent widening of the bands is often followed by a sharp price move. 6. When the price breaks through one of the bands, this is a sign of strong momentum and we should expect the trend to continue. 7. When the price returns through the band, expect a pause in the trend unless this crossover is associated with a trendline break, in which case the crossover probably represents exhaustion.